The kind of uncertainty that's being created by the chaotic tariff policy is something that has to give anyone pause.
It's been more the uncertainty around policy that has crimped our forecast.
We will get some clarity next Wednesday. I think the big question is, does the market like that clarity?
The correction in the market is the market telling we don't like these policies or we don't understand these policies.
I think there's a scope for it to be peak policy uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday on a 3-day winning streak as a softer tone emerges from the White House.
It's reciprocal. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
Investors getting a boost, and there might be more to come as a Republican tax plan begins to come together.
There's no daylight between House and Senate Republicans. We are one team. We have to bring stability to the markets. We've got to make sure everybody's tax rates are locked in, and they know that.
Clarity can't come quickly enough as consumer confidence continues to drop, falling to the lowest level in more than 4 years. The soft data is still looking soft.
Right now, it looks like the market is looking past the soft data, and certainly a number of Fed officials are as well. What we saw is Fed Chair Jay Powell dismissing some of the soft data as not necessarily predictive of what's to come. And we heard some things, similar yesterday from both the Fed's Williams and Goolsbee. Question is that sort of what we're going to be looking at going forward? Is this the new tone, or is this a brief reprieve at a time where suddenly there's more of a nod to markets?
There's definitely been a tone shift in the last 24, 48 hours, and now we can get hopeful, can we, about a tax plan coming together down in D.C.?
Treasury Secretary Scott Bessent says that potentially yes, because they're going to see a swift resolution when it comes to how the House Republicans and Senate Republicans are looking at the tax bill. I would say yesterday is a good start. This timeline, very aggressive. They want this done before the summer. There's 2 reasons why maybe they can get there before the summer. One of them, the most pressing, is the fact that they're under pressure because of tariffs and what you're seeing in the soft data. And 2, because there's a debt ceiling looming in the summer. And Donald Trump, the president, wants to see the debt ceiling negotiations come together with this reconciliation package.
This has been the strategic anchor around a bullish view for a number of months now, that when you take a step back in 12 months' time, the fuller policy platform has a bullish mix to it. Pro-growth, pro-risk. Taxes, though, are a big part of that story, and that's the development we need to see in the next several months.
And it seems like the GOP is moving pretty quickly, although this is what I'm really wondering. Looking forward, you take a look at what this plan is. It's kicking up the debt ceiling limit, potentially by $4 trillion, and it's including $4.5 trillion of tax cuts with $2 trillion in spending cuts. That increases the deficit almost $3 trillion over the next 10 years. At what point does that become the main theme, particularly for debt markets that seem to worry more about things like that?
3-day winning streak on the S&P. No worries over the last 3 days. Equity futures this morning down just a touch. We're negative by 0.2%. Coming up this hour, Marvin Lowe of State Street with stocks on a 3-day winning streak. Amrita Sen of Energy Aspects as Russia and Ukraine agree to a Black Sea truce. And Max Kettner of HSBC going underweight the US across the board. We begin this hour with stocks looking for a 4th consecutive day of gains. Marvin Lowe of State Street writing, there is a life cycle to market uncertainty where investors get to a point that most outcomes become reflected in valuations. We think that is increasingly the case with tariff risk. Marvin joins us now for more. Marvin, good morning. Good to see you. Can you ignore consumer confidence and the soft data of the past few weeks?
I mean, you can't ignore anything. I mean, we have to absorb the data. What we can do is realize that there is such a disparity in how that data is coming in, based on partisanship, if you will, and the administration's ability to effectively dominate the news cycle has to be playing into psyche. So maybe for me, the importance of the soft data is not as great as the hard data. I think we're hearing that from Fed officials, and to a certain degree, it's like I'll lean on hard data always over soft data, but it needs to be seen. And a lot of the things you talk about in terms of resolution to these concerns is part of that story.
We've spent the past few weeks asking who would blink first, the Trump administration or Chairman Powell and the Federal Reserve. Did we get the answer to that in the last 24 hours?
I think to a certain degree the Fed blinked. Having said that, they are very much leaning on those growth concerns. So they're not necessarily taking the administration tonic as gospel in terms of what it's going to do to growth.
Do you think the positive tone is because the Fed blinked or because the administration blinked? Because right now there does seem to be a different tone, to John's point. And this comment, which we just heard earlier from House Speaker Mike Johnson, we have to bring stability to the market. Suddenly there is an expediting of that tax plan. How much is in recognition of some of the instability that we've seen in markets?
Yeah, you know what? Certainly the sliver of a Fed put is powerful. And the economic projections, despite the fact that it's showing that the Fed has no idea, the way the market has no idea, is an important change in market theme. Having said that, there has been a change in the tone of the administration. So, what is more powerful? They both came together at the same time.
There have been a number of people who came on the show and said this is just a momentum trade unwind, and now we're kind of dealing with the other side of it. Maybe we've readjusted positioning and can now trade more on fundamentals, whatever that means. I was noting yesterday that VIX fell to the lowest in about a month, and we saw Mag 7 up 6.2% over the past 3 trading sessions. Yesterday, equal weight was down. Are we basically reverting back to the momentum trade in a way after it getting washed out?
So I do think washout of positions was an important theme in the first quarter. We're much more balanced, whether we're talking about it from an equity perspective, a currency perspective, not necessarily on the fixed income side of things, which continues to express concerns that the other markets haven't gotten into. Bond guys were always a bit more worried than anybody else in the room. It does give the ability to these large institutional investors to go either way. I don't think they're ready to go there yet because we still don't have that clarity. But that washout in positioning was an important theme that, we understand from a technical perspective in our seats versus, what's going through the headlines.
Are we going to get clarity next week on Liberation Day, April 2nd?
You know what? Whether or not we get the full amount of clarity in terms of what a potential endgame is, I don't think that matters as much. I think what we're going to see is the administration is moving forward with fairly aggressive tariffs, much more so than we thought in the first quarter. And we're OK with that because we understand that a bit more now. It's really the retaliation or retaliatory aspects that might evolve, which will keep the market offsides, and the fiscal side of it. That's the discussion in the second quarter going into the third quarter.
When it comes to the tariffs, though, why do you think that they're going to be very aggressive? We had the Europeans yesterday. Mexican delegation will be today. They're having negotiations before April 2nd. And Donald Trump said last night on Newsmax he's willing to be lenient when it comes to tariffs.
You know what? They need the revenues, number one. So, there isn't as much room as saying just going away. The CBO released some data about what the full suite of potential administration policies would do to the deficit, and they're frightening. So they need the revenues, number one. Number two, they're going down a route that is, from an aggressive perspective, much more than the easy, soft touch that I think we entered the year in. That this administration, from a tariff perspective, was going to look like 2018. And clearly, that's not the case.
You believe this is about raising revenue?
I think it's part of the discussion, for sure.
Canada, Mexico, raising revenue or something else?
Canada and Mexico has to be part of the equation because they're such large trading partners. Europe has got to be part of the equation because they're such large trading partners. Are there side goals associated with that? Yeah, I'm sure there are. European defense spending. I mean, we've gone down a route that ultimately no one would have expected 6 months ago. So, they're getting a lot of what the administration wanted back in 2016, 2018 by pushing this tariff discussion.
For the market, how important is it for these two pillars to be side by side? April 2nd tariffs, end of May, a tax extension.
They are part and parcel. The debt ceiling is out there. We've got just a litany of stress points when it comes to, the dollars and cents.
Do you think it's enough, though, for this tax bill to just be an extension of TCJA and no other extras?
Well,
how does the market get excited about status quo policy that we have current day?
Yeah, it's really a function of, I think, how the debt market absorbs that information. The debt sustainability story, it comes and goes. But the fact that the 10-year is still kind of in this mid 4% range where we're talking 4.25%, 4.5% is unsustainable from a funding perspective. It is really, really important. And I think it's why we hear the administration talking about the 10-year as much as they do.
I'm so glad you went there. Today, $70 billion of 5-year notes being auctioned off at 1 p.m. And tomorrow we've got $44 billion of 7-year notes. At what point, if the budget as is goes through, do bond investors start to worry once again about funding issues?
I don't think the worry went away. I think if we're talking about recession, if we're talking about a Fed that's really putting a small put on the table because they're worried about growth and worried about recession, you would normally get a much more aggressive reaction coming out of the bond market.
You know, it strikes me, and we were talking about this yesterday, that stock markets are worried about tariff risks. And the bond market is worried about this budget and tax cuts and trying to understand exactly how this goes through. Do you think that potentially the bond market is going to be much more volatile over the next few weeks and months ahead as these budget negotiations really get going?
Yeah, I do think so. I do think so. Term premiums really haven't expressed any degree of concern, even relative to what we saw a few years ago when we started really talking about the amount of debt that needed to be termed out. There is a risk to really relying on the short end as much. I mean, you talk about auctions, in a way that's quite cohesive to just the risk that we're taking. That creates volatility.
Marvin, appreciate your time. It's good to see you, sir.
Thank you.
As
Nice
always,
seeing you
Marvin
also.
Lowe there of State Street. Lisa taking us to the bond market. Yields just a little bit higher today, up by a basis point. The 10-year still in and around 4.30. Let's turn to your Bloomberg brief, an update on some of our top stories worldwide. US, Russian and Ukrainian officials announcing a ceasefire in the Black Sea. But Russia saying the deal is conditional on sanctions relief. The ceasefire ensuring safe navigation and preventing the use of commercial shipping for military purposes. Elsewhere, Republican leaders saying they're close to agreeing on a plan to extend President Trump's 2017 tax cuts and increase the debt ceiling. House Speaker Mike Johnson saying the Senate counterparts are, quote, coming around. And finally, Dollar Tree is nearing a sale of its Family Dollar business to a group of private equity investors for roughly $1 billion. The Wall Street Journal reporting a deal will be formally announced as part of Dollar Tree's earnings report out later this morning. That stock is higher by 6%. Up next on the program, a softer tone emerging from the White House.
Not too many. Not too many exceptions. No, I don't want to have too many exceptions. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
A shift in the last 24 hours. On that shift, Jeannette Lowe of Strategas, a bad company, joins us next. Live from New York City this morning. Good morning. Three-day winning run on the S&P 500, the longest daily winning streak going back to early February this morning, just a little bit softer. We're negative here and down a little more than 0.1% on the S&P. On the Nasdaq 100, softer by 0.2%. Under surveillance this morning, a softer tone emerging from the White House.
Not too many. Not too many exceptions. No, I don't want to have too many exceptions. I know some people say, oh, do you think it's too much? Well, they've been doing this to us for many years, whether it's China or India or Brazil or so many other places. And all we're going to do, it's reciprocal. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
So here's the latest this morning. President Trump indicating he may be more lenient than reciprocal, suggesting a softer than expected touch when he unveils additional tariffs on April 2nd. Bloomberg's Tyler Kendall joins us now from the White House for more. Tyler, what do you make of the shift of the last 48 hours?
Yeah, well, good morning, John. President Trump's comments suggesting that the reciprocal tariff plan on April 2nd might not be a tit-for-tat response when it comes to the current trade barriers, despite this White House always saying that what they charge us will charge them. Our reporting still indicating that the White House is likely to focus in on that top 15% of trading partners who make up the bulk of the trade imbalance with the U.S., even as he says that exceptions are going to be rare. Important to note that President Trump did go on in that interview to say that sometimes so so-called friends are worse than foes. He singled out the European Union, perhaps giving us some insight into how that trade talks went yesterday with the EU trade chief and senior administration officials. I also wanted to point out the context of this question that President Trump was answering. He was asked whether or not how high his tolerance was when it comes to an adjustment period in the economy due to tariffs. And the interviewer had suggested maybe that's why he's going to give exceptions. And he said, well, no, not too many exceptions. A senior White House advisor, Stephen Myron, was on Bloomberg Television earlier this year. He also, earlier this week, he also said that he felt that tariffs weren't going to contribute to this adjustment period. And rather, the reorientation, as he called it, was from moving from a government-driven economy to a private sector-driven economy. John, as you know, this, of course, comes as those consumer sentiment data numbers hit 4 years lows yesterday, with the Conference Board writing that it was partly due to tariff concerns.
Tyler, another pillar of the Trump agenda, of course, is the tax cuts. And we got some insights yesterday about how those negotiations are going. And for the first time in a while, it does seem like House Republicans and Senate Republicans are on the same page. What happens next?
Right. Well, Annmarie, there's still some big hurdles that they do need to cross, and we should caution that it is still very early on, even as we do get some positive signs from leaders yesterday after they emerged from their meeting with Treasury Secretary Scott Bessent and NEC Director Kevin Hassett. The two big things on the table that they still need to tackle, whether or not a debt ceiling increase will be included in this bill, as well as those top line numbers. There does seem to be some disagreement, particularly about that $4.5 trillion tax cut blueprint that's currently baked into that House plan. We know that Senate Republicans would like to see that number larger so that they can make permanent those 2017 tax cuts. And then there's disagreements about the spending cuts. $2 trillion is what's currently factored in, but Republicans are already raising concerns about what that could mean to some social programs like Medicaid.
Hey, Tyler, appreciate the update. Tyler Kendall of Bloomberg down in Washington, D.C. We'll hear more from Tyler later on this morning. Tyler mentioned consumer confidence. Consumer confidence dropping to a 4-year low. Expectations 6 months out, the worst in some 12 years. Inflation expectations, the highest in 2 years. And expectations for personal finances, the lowest since July 2022. Certainly compared to expectations coming into 2025, the White House and this administration moving harder and faster. Jeannette Lowe of Strategas, a bad company, writing, when we added up what has already been announced in terms of tariffs, we found that it would be a $235 billion impact over 12 months, or 0.7% of GDP, which is more than many investors were expecting. Jeannette joins us now for more. Jeannette, welcome to the programme. Certainly surprising how hard and fast they've moved since they walked into the White House. Are you seeing any signs over the last couple of days that maybe they're just softening their tone, just maybe backing away a touch?
Yeah, absolutely. I think they are trying to start to walk back a little bit. I think there hadn't been a lot of numbers put out there of what the actual impact was. And so we really try to take what has actually been levied already on China and Canada and Mexico and with steel and aluminum, and then add in reciprocal tariffs and then sectoral tariffs. And I think that number started to surprise some folks. And if you see all of that coming in at once, that can actually be negative for the administration. Now, obviously, we're still getting mixed signals, so we don't necessarily know, will some sectoral tariffs on maybe autos still be announced? That is kind of up in play. And you also we have reciprocal tariffs that is just focused on higher rates that other countries charge. But then the administration also wants to include what those countries charge in VAT taxes and put that into the equation, and some other non-tariff barriers. And that, I think, is the question. So they need to kind of figure out what pieces do they actually want to include, and then how that actually can be structured, because it could be quite a shock if we come on April 2nd, depending on what is announced, if they don't pare some of this back.
Well, when you mention VAT, I immediately think of the European Union, and the Commissioner for Trade yesterday is all smiles, standing alongside Howard Lutnick and Jamieson Greer, Kevin Hassett, after their intense negotiations, what he's calling it. And he says the EU's priority is a fair, balanced deal instead of unjustified tariffs. Do you think he's going home to Europe with a deal?
Yeah, I mean, so this is what's interesting, because I think, we did hear some talk about lowering the tariff rate on autos, and also trying to get the U.S. to lower its tariff rate on pickup trucks. That's something that obviously can be done, that has been a bone of contention for President Trump for some time. But I think you also have to really watch this VAT piece, because I think overall, if you look at just applying higher tariff rates on European goods, it's not going to be as much of a significant impact. If you start to add in VAT taxes and that impact, that's much higher of an impact on the European Union. And it's also more difficult for them to change that. They're not going to be able to easily change those taxes for for the Trump administration. So it's harder to see where that negotiation could come into play. And I think that's going to be important as we move closer to April 2nd and get more details.
When we get more details on April 2nd, what kind of tariffs do you think we will see immediately? And then what other legal measures will they rely on that will take weeks or months, say 232 or 301?
Yeah, I mean, I think that they are going to try to announce several reciprocal tariffs immediately. Now, I think the question is it a 30-day implementation period, kind of like what we've seen for some of the other pieces earlier this year, but it might be more on select countries. So they're not going to probably go for a universal tariff, which is what they were talking about doing earlier this year. We've moved much more from that universal tariff to this reciprocal piece. If it's reciprocal, it can also be country by country, which means maybe you can apply it to a handful of countries at one time and then add in other countries down the road, allows for more negotiation and that piece. Trump has also been talking about, that he wants to do tariffs on autos, and he says that he's going to announce that soon. If you add in a VAT on the EU, that kind of also hits the European Union on autos, particularly Germany. It would hit Ireland in terms of pharmaceuticals. So that's going to be an important piece. And I think the other thing that's really important, too, is what happens with Canada and Mexico. There are significant tariffs right now if we're talking about whether or not goods are USA compliant or not. And are those changed on April 2nd? And do they go just to reciprocal tariffs, which is much more manageable? Or do we have reciprocal on top of what has already been announced for Canada and Mexico? And that could actually be much more burdensome and much more troublesome for the market.
I feel like we're all trying to put together a tariff puzzle and figure out what pieces people are saying and then put it in its correct place. And if we were creating that kind of puzzle, where would this copper tariff piece really get put yesterday when President Trump announced that he is going to put tariffs on copper and has previously discussed something like 25% of all incoming copper imports?
Yeah, I mean, so this is something that they are trying to rush, right? So usually you have 270 days to do this kind of investigation. And this is something that he did with steel and aluminum. So, but it allows at least a little bit more of a process with regard to having input from the public and from companies that would be impacted. But I think this is something that he is trying to target certain areas. And he feels like the steel and aluminum tariffs, you saw that we now got rid of the exemptions. With copper, that could be a similar story. It also could be potentially somewhat of a negotiating tool if you can announce it. And then it kind of hits certain partners and there's an opportunity there. But it seems like with the commodity tariffs in particular, Trump looks to be looking to focus on putting those into place and not allowing as many exemptions. So that's something we're definitely going to be watching going forward.
Jeannette, there has been this shift in tone more generally, and John started the show talking about it. We've been feeling it in terms of market performance, and we're hearing it not just from the White House and tariff negotiations, but also from the House, with House Speaker Mike Johnson coming out yesterday saying we have to bring stability to markets, saying that negotiators around the budget, not necessarily tariffs, need to give people certainty so that they can, quote, make decisions about expanding their businesses and jobs. How much are we hearing a kind of around the table feeling of concern about the uncertainty in Washington, D.C. that is a material shift than, say, even a couple days ago?
Absolutely. I definitely think that this is definitely a part of the conversation for policymakers. And if you think back to the first Trump term, you had them passing a tax bill first and then going in and putting on tariffs primarily on China. So they were much more modest in scope than they are today. And that created a cushion for the market. This time we have the opposite. We have tariffs coming into place first. We're not obviously going to have a tax bill done by April. So you're going to have that more difficult piece coming in first before you get some of that fiscal policy to help balance it out. I think you do see members of Congress thinking about what will be the tariff impact and thinking about, do we need to include some more pro-growth tax policies within that tax bill? So kind of bringing back the R&D, immediate expensing, having 100% bonus depreciation, doing that potential 15% tax rate for domestic manufacturers, potentially even other pieces. So I think they're going to have to start thinking about those proposals. And I think they are currently, and how they get structured. And then as we get the tariff announcements, that will give them more to know what they need to do moving forward as that tax bill actually gets built.
Jeannette, appreciate your time. As always, Jeannette Lowe there of Strategas, a bed company, on the latest push down in Washington, D.C. I think a lot of you saw the consumer confidence number and made a similar observation. Consumer confidence at a 4-year low. Those numbers are worse than when inflation was north of 8%, approaching double digits, and the Federal Reserve was hiking aggressively. That's how much consumer confidence has softened up over the past few months. Up next on the programme, we'll talk about energy. Amrita of Energy Aspects, as Russia and Ukraine agree to a ceasefire in the Black Sea. Equity softer here following a 3-day run of positive S&P 500 moves. We're down by about 0.1% on the S&P. On the Nasdaq 100, we're down by 2. Later this hour, 15 minutes away, Max Kettner of HSBC going underweight US risk assets. It's no longer about Goldilocks, but whether the sentiment shock will spill over into the hard data in the United States. That conversation, 15 minutes away. With 3 hours until the cash open, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. We have a couple movers to get through, but in earnings. But it's not really earnings that is moving the stock, at least for GameStop, because they reported earnings where sales plunged 28% year over year. Instead, it is a separate announcement from GameStop saying that they are going to be adding crypto to their reserves, specifically Bitcoin. They're going to be holding that as a treasury asset. And again, this stock is one of those meme ones and gets people excited with these sorts of announcements. So those shares up nearly 13% in the pre-market. Now to the downside, Nvidia down 1% this morning. A story from the FT really interesting that China is looking at placing environmental curbs, which would mean that Nvidia's chip, especially tailored to the Chinese market to overcome U.S. curbs, would not be allowed to be used and sold by the tech giants in China. Of course, it's not being enforced, that ban, quite stringently, but if it is, it would have huge implications for Nvidia. Finally, rounding things out this morning with Dollar Tree, we should hear from them for their earnings this morning. We don't have that yet. Will be interesting to see what the consumer is doing. See some back and forth, up 0.5%. Dollar Tree going to be selling one of its assets to a consortium, its Family Dollar business, a consortium of private equity. That deal for about $1 billion, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, the Mexican economy minister set to visit Washington today for trade talks with U.S. officials. The visit coming just 1 week before President Trump's Liberation Day, when he's expected to announce reciprocal tariffs on trading partners.
So I thought it was very interesting last night, this tone shift, Jonathan, you've been talking about. Trump said he'd probably be more lenient than reciprocal. And what we've seen all week are meetings after meetings with trading partners. Today, it's Mexico. Yesterday was the European Union. The European Union trading commissioners talking about the fact that this was very intense negotiations and they like to get to a deal. There's also negotiations happening with India. So potentially before April 2nd, Trump is going to come out, starting at a maximalist approach, but come out and say, I was able to strike a deal. It's not as aggressive as we've been talking about, but it's reciprocity, which really is the buzzword for this administration.
I want to understand how the Mexico negotiations in particular had to do with cars, considering the fact that they came with respect to this Made in America electric bus, Made in Mexico electric bus tour. It's a question right now that I'm wondering, is Cliffs idled one of their factories as a result of a lack of U.S. auto demand? It's just a lot of moving pieces, and how this factors into the negotiations still is somewhat of a mystery to me.
Things are lining up for a much more market-friendly outcome in the next week or so. But as we've said repeatedly on this programme, things can move the other way just as fast. Yes, we've had a softer tone from the president. Yes, it's encouraging that we're actually seeing trade officials from Europe, from Mexico, come to Washington and negotiate. But I'm not sure how much weight, how much trust you can have in the idea that that sentiment shift we've witnessed over the last 24 hours or so will actually stick.
That's true. We need to actually see what they come out with on April 2nd. But at the moment, I think it's fair to say the bark we saw when they entered the White House is not going to be as harsh as the bite we might see on April 2nd. What is interesting, though, and I think Marvin was getting to this point, Trump 1.0 was about China. Phase 1 trade deal, heavily focused on agricultural and goods. Trump 2.0 is the rest of the world. It's everyone else, including America's closest trading partners.
Let's talk about the rest of the world. The United States announcing that Russia and Ukraine agreed to a ceasefire in the Black Sea. The Kremlin confirming the agreement, but saying sanctions need to be lifted on banks and companies involved in agricultural exports. So which one is it?
I think it's the Kremlin looking for any more concessions they can get. Vladimir Putin is also going to deal with Donald Trump in a maximalist way. What caught my eye yesterday was actually the Director of National Intelligence coming out with the latest unclassified assessment. And they said that when it comes to Ukraine and Russia, quote, leaders for now probably still see the risks of a longer war as less than those of an unsatisfying settlement, meaning they rather drag their feet. As Donald Trump said last night in this Newsmax interview, I think that Russia wants to see an end to it, but they could be dragging their feet before they come to an agreement. In this moment of a negotiation, they're both going to come in, and specifically Russia, given they have 20% of control of Ukrainian land, with a maximalist approach.
I guess what is a maximalist approach? It's that we're not going to do anything until you lift all sanctions, and that's Russia. And it raises a question of just how quickly Russia can reacclimatize to the global trade system, and whether that's actually in the offing, and whether the European Union will really get on board with that.
I can tell you the max bullish outcome of all of this, if they back off on trade, if we get a deal in Ukraine, if we can get energy prices lower and then focus on this, taxes, things could be in a much better place. Republican leaders saying they're close to agreeing on a tax cut plan. House Speaker Mike Johnson also saying the Senate is, quote, coming around to supporting a debt ceiling increase as part of the legislation. All of that is starting to sound a little bit better compared to where we were a week or so ago.
So now that the debt ceiling is part of this means that they have a serious timeline. What economists will tell you is that we're going to hit that X date on the Treasury when they can't pay their bills by maybe the middle of the summer to early fall, which means if they are going to include debt negotiations part of reconciliation, they have to get it done by September, really the latest, but they're being very aggressive. They want this done by Memorial Day. Now, it all sounds like happy talk coming out of the Treasury Department yesterday in this meeting that Scott Bessent held, the Treasury Secretary. I will say there's going to be a number of senators that maybe Donald Trump himself needs to start whipping their counts. You look at someone like Senator Ron Paul. He came out and he said, they lost me. I'll never sign up for a deal that includes increasing the debt ceiling.
The focus is slowly shifting. Let's shift the focus back to commodities. Oil edging higher following an industry report which signaled a large decline in US crude stockpiles. Traders also weighing the prospect of a Russia-Ukraine ceasefire in the Black Sea. Amrita Sen of Energy Aspects joins us now for more. Amrita, welcome to the programme. Let's get to that potential ceasefire that we could see between Ukraine and Russia on a much larger scale. What would that do to energy prices? What would that do to the flow of energy?
Firstly, I don't think we're going to get a ceasefire anytime soon in the true sense of the word, like you guys were discussing. I think there'll be a lot of noise. And I think we have to remember that both sides, Russia and Ukraine, are going to tread this kind of line where they all appear very positive and, all the outcomes are very positive. But if you actually look at it, nothing has moved. I think the positive spin we are seeing out of DC on very, very minimal gains has been impressive, no doubt. But if you actually read through the details, there has been no shift from either side on their red lines. And I think that's the critical thing. Remember, the headlines will have to put a positive spin so that neither side angers the current precedent. I think we need to look at the whole thing through that lens. In terms of sanctions lifting, remember, we haven't lost any Russian oil because of sanctions. India and China continue to buy that oil. Any Russian oil we've lost is because of OPEC plus policy. That's not changing. OPEC is going to continue to bring back barrels over the summer months. Russia gets a part of that. That's fine. Beyond that, nothing. One last thing, US sanctions on Russia, if they were to be removed without Europe going ahead, that is actually bullish for oil, not bearish, because the original European sanctions were designed so that Russian oil couldn't flow at all through Western shipping sanctions. The price cap was designed to allow that to flow. If you take away the price cap, the European sanctions kick in without this caveat, and therefore really no Russian oil will be able to move other than in the dark fleet. People forget that.
Amrita, are they even enforcing the price cap right now, though?
No, but the whole point is the price cap gives you the ability, you can claim whatever the price it is, but you can say, oh, because of the price cap, we are able to move it. If you take the price cap away, the European sanctions say they cannot use any Western shipping or insurance services. That's the critical thing, because at least the price cap gives you a way to get away from it.
When it comes to other potential energy flows we can see, if they were to get closer to a ceasefire agreement, Sergei Lavrov, talking to TASS News, Russian state media yesterday, said that Nord Stream, there is talk of Nord Stream coming back online. Amrita, what do you make of that?
I think, again, there's going to be a lot of noise, a lot of headlines in terms of, again, gas. I think it is going to be more important for gas than it is for oil, just given the volumes lost, right? Like I said, oil we haven't lost. But we keep forgetting this is Russia also trying to create a wedge between Europe and the US. And that's why certain statements like that, of course, we're going to bring Nord Stream. And by the way, Europe, you need our gas. Europe has a big say in this. And the European sanctions are actually the main sanctions on Russia, much more than the US ones. It's the opposite for Iran.
But how much will European gas actually be helpful to Europe? I mean, although Europe has a lot of tough rhetoric when it comes to Russia, they're still importing Russian gas.
Oh, yeah. And look, I think this is the biggest question mark that I don't think anybody will have a true answer to, in the sense that we are losing so much industrial demand, and we have lost, I would say, 15% of gas demand we believe is never going to come back in Europe because of the high gas prices and the relocation of industry to places like the US. So the question then becomes, yes, Europe is talking about more renewables and kind of tripling down on it. But if it's, again, not our base case, but if you suddenly start to get a ceasefire and sanctions get removed, does Europe actually change that? We do think some European countries will go back to Russian gas, but we're not going to get the volumes back anywhere close to where we used to be pre-war.
Are you saying, Amrita, that if there is an end to the war between Ukraine and Russia, that it will have an immaterial effect on the price of oil?
What's going to happen is that Russian differentials, which now trade at a discount, will go up because Russia no longer needs to discount its oil, right? Because right now it's having to discount to clear. But on a volumetric basis, no, because Russia is already producing as much as it can within the OPEC Plus framework, is just sending it to China and India.
Before we let you go, I do want to get your take on copper and what we heard overnight from President Trump and the likelihood of pretty aggressive tariffs on copper, this goal to bring manufacturing back to the United States. Shipbuilding is a big piece of that. That's also a part of the steel and aluminum tariffs. How much does that shift the cost of copper in the United States? We've seen a real departure of what's traded in the U.S. and what's traded on the London's Metals Exchange.
Yeah, and I think this is, it's not just copper, like you mentioned, steel and aluminum. Look, I'm in the Midwest myself. I've been meeting with a lot of the producers, including some who were in the meeting in the White House just last week. And I think the shift in metals prices is becoming a real talking point for both upstream and downstream. And shipbuilding is, I'm including them in the downstream, just in terms of certain producers are telling me their raw material costs have gone up anywhere between 15 and 20%. And I think that's why you are going to get that price discrepancy between US metals markets and the rest of the world, simply to kind of basically price that in. And I think metals markets are going to go through this huge period of volatility until we have more clarity on the 2nd of April.
Amrita, appreciate your view. Thank you. Amrita Sen there of Energy Aspects. Need to get some news for you, some breaking news as well. Here is your Bloomberg brief. We start, first of all, with Dollar Tree. Fourth quarter net sales falling 42% year over year. This is the discount chain formally announces it will sell Family Dollar. Dollar Tree expecting net proceeds from that sale to reach $804 million. Elsewhere, US consumer confidence falling to its lowest level in 4 years. The Conference Board's measure showing concerns about the economic outlook under President Trump's tariffs. And finally, the US Treasury planning to lay off a, quote, substantial number of employees as part of Elon Musk's Doge efforts. The Treasury hasn't made final decisions on the layoffs yet, saying they'll be tailored to each bureau. And that right there is your Bloomberg brief. Up next on the program, uncertainty all around.
We've seen a really large and pronounced pullback in both business and consumer confidence.
Uncertainty around policy that has crimped our forecast.
Commentary on the outlook is as wide as I've never seen it.
Up next on the program, Max Kettner of HSBC in the last 24 hours downgrading US equities. Things have been so choppy that we haven't seen a 3-day run of equity gains since February 6th. On the S&P 500 this morning, we come back just a touch. We're down by not even 0.1% on the S&P 500. Similar amount on the Nasdaq 100. Under surveillance this morning, uncertainty all around.
We've seen a really large and pronounced pullback in both business and consumer confidence.
Uncertainty around policy that has crimped our forecast.
Commentary on the outlook is as wide as I've never seen it.
Given the kind of kneecapping that we are going through from a policy standpoint, that raises the risk of a potential slowdown
So here's the latest this morning. Uncertainty is pressing on global sentiment with a week until President Trump's April 2nd tariff deadline. Max Kettner of HSBC downgrading US equities to underweight and writing economic and political uncertainty is unusually high, but dismissing the U-turn in leading indicators and price indicators as a one-off or outlier seems quite far-fetched to us. Max joins us now for more. Max, welcome to the programme. This is a significant change for you, and I stress for people who aren't familiar with how you've called this market over the last year, you are no bear on stocks, no bear on high-yield credit. You've been bullish when it was the right time to be bullish, and now you've made a move to go in a different direction, Max. So let's take a step back and think about why. What is it that you see that tells you that this uncertainty will persist?
Yeah, good morning. Look, I think what the difference now is to perhaps a month or two ago, we could have dismissed it as pretty much only consumer sentiment. We could have said this is pretty much driven by a political division. It's not something that is broad-based. It's just a couple of surveys, just a couple of soft data, particularly on the consumer side, and it's driven by one particular thing, so you can dismiss it. What's changed, I think, now is we see a much more sort of broader-based slowdown among all the soft and the survey data. You look at, for example, CEO confidence. We had the biggest one-month slump since September 2008. I think we all know what happened there. You know, you've got in the Philly Fed, you have the biggest 2-month drop in new order expectations in history. That series goes back 55, almost 60 years. We've got the biggest 2-month drop rate. You know, it's not just, it's on the labor market as well. You look at consumer expectations, consumer sentiment on labor market conditions, clearly looking for negative payrolls there. You look at challenger job cuts, clearly biggest jump there since COVID. So my concern is that people are focusing in the hard data. They're looking at the hard data from January and they're saying, you know what, that's holding up. So let's dismiss the soft and the survey data. But I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
So underweight stocks, underweight high-yield credit, underweight investment-grade credit. Is this a bet then, Max, that this is going to show up in the hard data in the next few weeks and months?
Yes, absolutely. I think what we've done is essentially we've introduced a big sentiment and a big confidence shock into a US economy, which actually has been picking up and has been improving in the second half of last year. When you look, for example, at the labor market, remember payrolls, people were saying, well, it's just government and healthcare jobs. Well, in fact, when we look at the second half of last year, the net number of industries hiring was picking up. So even the labor market breadth was actually improving. And we've seen a lot of sequential numbers which actually were improving in the second half. So it's a bit like, you know, we've boarded a train that's been improving and been running in the second half of last year. And now we're suddenly introducing a confidence and a sentiment shock. So to me, I don't think this will take 3, 4, 5 months. I don't think this is going to be a recession that is going to be, you know, basically coming sometime in the second half. I do fear that we might get a pretty sharp slowdown in the data very early on and very, very soon.
Well, which raises the question of how much this is a challenge to the entire U.S. exceptionalism bet. And I know this is a tired horse at this point, but it is essentially what you're saying. It's dollar assets. It's a reversal of that trade. How much is this hinged to what's going on elsewhere?
Yeah, look, I think on the US exceptionalism case, however, that is, you know, a question of cyclical, tactical versus structural. So it's really a case, or a question of, are we completely putting to bed the idea of US exceptionalism? Are we putting to bed the idea of US companies having much better return on equity, much better corporate profitability compared to European, Japanese, EM, basically rest of world companies? That is a structural issue, and that is not going away. So this is not a call on the end of US exceptionalism. I think it is much more a call of perhaps sort of a near-term, really pretty bumpy ride in terms of hard data following the broad-based decline that we've seen in the soft and the survey data. On a more longer-term structural issue, I really doubt that we're going to get sort of a structural, strategic shift away from US assets into European assets, into rest of world assets out of the US. I heavily doubt that, because for that, the relative profitability picture in the US still looks much better. And let's not forget, the liquidity and the depth of the US market is still nowhere near where the rest of the world is. The rest of the world cannot compete with that, with what the US has to offer there.
Which is the reason why, Max, I understand the US equities call. I don't really understand the U.S. debt call. If you think that growth is truly going to sharply slow down, why not go into U.S. debt, particularly investment-grade debt, especially in favor of European debt, where the yields are still blowing out as a result of some of the borrowing plans from Germany?
I think, look, when we look at a more broad-based sell-off or a broad-based correction, I think that is going to look perhaps really similar to what we've seen in July, August, September last year, which was essentially a US-driven sell-off. It was a US-driven recession fear. It wasn't, remember back then in summer, we actually had the dollar sell off into recession fears because people were saying, well, this is a US-specific issue. It's a US-specific recession concerns. And that, I think, is very similar to what we're seeing right now, where perhaps the dollar doesn't really play that much of a safe haven role. And I would say, look, the difference, what we're seeing right now to an absolutely crystal clear classic risk off is that there is stagflationary concerns as well. Let's not forget that in the last 4 months in the US, goods prices have been picking up. We know that, prices paid have gone up in the PMIs. We know in the regional Fed surveys, when we look both on services, particularly in manufacturing also, price paid expectations are almost back on an aggregate basis to the level where we were at the peak in 2022. So there are these stagflationary concerns, which perhaps also put into question the US debt role, so US Treasury role as the ultimate portfolio hedge there. To me, the much clearer hedge here is gold. That's why we've even increased further an already really outsized overweight that we had in gold.
Max, when it comes to you, the most important thing that's really changed your sentiment, you say it's that since Inauguration Day, the administration's proposals have resulted in a sizable confidence and sentiment shock. What happens to the sentiment when potentially we get the entire package of the Trump agenda? Because right now what we see is they have a massive push in Washington to get the tax extension over the finish line.
Yeah, look, I guess that's part of the reasons actually why I'm concerned, because number one, what is the probability that beyond next week, beyond April the 2nd, we're putting completely to rest the tariff issue? We're no longer talking about tariffs at all. I think, that probability is probably very, very low. I have very, very low confidence myself in calling what the actual measures are going to be, the actual targeted tariff measures are going to be next week. I have much greater confidence in saying, actually, next week, it's not going to be the end of tariffs. We're still going to talk about this, perhaps, with regard to Europe, but also with regard to other jurisdictions. So that issue is not going to wait. That's number one. Number two is on the tax cuts. We still don't have the revenues. We're talking about a $7 trillion budget. And of course, the last 2-3 months, the US administration has been talking about relentlessly cutting the budget. You look at the weekly outlays of the Fed, that's not happening. It's absolutely not in the numbers yet. We're not seeing that on an aggregate basis. The US is still spending the same amount of money that they've been spending year to date last year, the same amount. So I do worry if they want to bring the tax cuts over the line and also the tax extension of the 2017 corporate and income taxes. The worry that I have is that the bond market also is going to vote with its feet. And then we don't have an earnings-driven sell-off in equities and spreads. We have a multiple and a valuation-driven sell-off driven by the rates move, really.
Hey, Max, this is a change, sir, and it's good to get some clarity from you. Max Kettner there of HSBC. We have had a tone shift down in Washington, D.C. Whether it sticks, I don't know. But essentially what Max is telling you is it's a little bit too late. Sentiment has already shifted, and he's anticipating a drop-off in the hard data in the weeks and months to come.
When you take a look at the U.S. Economic Surprise Index from Citi, it still is below zero. When you take a look at the Citigroup European Surprise Index, it is the highest level since June 2024. It has been a steady drip down, and he is concerned about it.
Equities just about unchanged so far this morning. In the second hour of Bloomberg Surveillance, Dan Greenhaus of Solus Alternative Asset Management, Tyler Kendall from Bloomberg down in Washington, D.C., Chris Maher of OceanFirst Financial, Yelena Shulyatyeva of the Conference Board. From New York, this is Bloomberg.
I think you'll see money rotate back into the U.S. and probably led back to the Mag 7 and some of these technology names.
On the 6 to 12 month horizon, we expect to go back to the U.S. taking the lead.
If you are a diversified investor, you actually feel good about having non-U.S. exposure.
I imagine the S&P 500 ending the year at about 6,000. but I think there's a lot of volatility ahead.
It's going to be important for investors to really dissect the signal from the noise.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Just moments ago, we caught up with Max Kettner of HSBC, downgrading US equities to underweight. We've got a new one. Venu Krishna of Barclays, just catching up with Venu over the Bloomberg terminal, cutting the price target on the S&P 500, his outlook, down to 5,900 from 6,600 this morning, saying the second order effects incorporate the risk around growth and inflation off the back of tariffs. It's a downgrade from Barclays.
And when he was on with us, it sounded like he was about to cut his outlook, and we were saying, you could cut it right here. There is this issue of if you extend the x-axis, to quote Tom Keene, there is a prolonged feeling that this kind of sentiment shift downward will have ramifications, and that seems to be what people are talking about in tandem with the unlikelihood of us getting a real kind of positive fiscal boost from some sort of tax package.
Barclays still don't expect recession. It's important to point that out, but they expect some weakness potentially in this economy. And certainly we've seen a sentiment shift, not just on Wall Street, but also in the last 24 hours down in Washington, D.C. from the White House. Is it too little, too late? Consumer confidence is a whole lot softer. HSBC thinks next up, it's the hard data. What we've heard from the president is maybe just a little bit of a shift relative to where they were in the past few weeks.
A shift, for sure, when it comes to the tone. But, Jonathan, it's a good point. Max Kettner was making this point. Maybe it's a little bit too late when it comes to the tariff rhetoric, which we're already seeing show up in the surveys. What President Trump is now saying now is he's using words like lenient instead of reciprocal, like last night with Newsmax. He also recently talked about how he's willing to be flexible. And all of this rhetoric is lining up with tangible meetings. We have the Mexican economy minister coming to Washington today. Yesterday, we have the European Trade Union. They're talking to the Indian delegation. There are negotiations underway before April 2nd.
We need to get a bullish view. Coming up on the program, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management as a softer tone emerges in the White House. Chris Maher of OceanFirst Bank on the impact of tariffs on small business lending. And Yelena Shulyatyeva of the Conference Board as consumer confidence hits a 4-year low. We begin this hour with stocks steady after putting together a 3-day winning streak. Dan Greenhaus of Solus Alternative Asset Management writing, the fact that some portion of the tariffs is being delayed underscores my more optimistic point. It's unlikely the worst of these tariffs are going to be implemented. Dan joined us now for more. Dan, good morning. Good to see you, sir.
Good morning to you, sir.
It's not just the soft data, so let's talk about the earnings. I know you've been focused on this. So Delta Airlines say activity stalled in the middle of February. Carnival Cruises have told us something completely different. So where do you stand on what the data is telling you and what companies are telling you at the moment?
So, listen, you said I'm more optimistic. And
based on that quote, you are.
Yeah, well, I did use the word, so I guess that's fair. Listen, I think at worst, the consumer's mixed. I look at earnings reports from Carnival, from Academy Sports, from Williams-Sonoma, from Darden Restaurants, all of whom told me something along the lines of the same thing, which is consumer sentiment has worsened, and we saw that yesterday, obviously, in the Conference Board number, but consumer activity still remains pretty healthy. And I think this ties into what you and Venu were just talking about, because I pulled up his note. He's taking it down on the implementation of tariffs and the idea that this is going to weigh on earnings, et cetera, et cetera. His downside scenario is 4,400, which is about a 25% downside. Everyone is living in the future. This is going to be bad. This is going to be bad. This is going to be bad. And what I hear and see from the consumer is that, yeah, it might be, but it isn't yet. And so I'm taking a combination of A, the reality on the ground looks fine to me. And again, Darden, Williams-Sonoma, et cetera, told me that. Along with the belief that the worst case tariff scenarios are not going to be implemented. We keep talking about April 2nd as Liberation Day.
Sure.
Annmarie talked about this yesterday. It's unlikely that the full force of these tariffs are implemented tomorrow. A lot of the stuff is very nuanced and item specific, sector specific, and it's going to take weeks, if not months, to play out. Does that contribute to an environment of uncertainty? For sure. But it also increases the odds that country X does something sufficient to delay them even further. And so I'm going to hold out hope that that's the reality that comes to pass rather than some of these worst case prognostications.
Is that hope, that last point, based on the visits we've seen from the Europeans in the last 24 hours, from the Mexicans later on today?
Yes, I think it seems, listen, I think the Journal today has a story, Europe's wrestling with acquiesce or fight against Trump. I'm decidedly in the camp that you should just acquiesce. This is a losing argument for a lot of other countries, and for all the reasons that everyone's discussed ad nauseum. We're a relatively closed economy, import-export-wise, compared to China, certainly Canada and Mexico. You're much more reliant on the U.S. than is everyone else. That's not to suggest that this isn't some version of mutually assured destruction. However, I think it's much easier for a lot of these countries to just acquiesce to the president. And I would add, I was at a consumer lunch yesterday and made this point, and surprisingly, some people agreed with me. I can make the argument that tariffs are deflationary. What if I told you that the reciprocal tariffs are being put in place where I'm going to equitize tariffs with everyone else, and everyone else says...
Okay, I'm sorry, I have to interrupt here.
Please.
Because we've talked to a lot of people about this. We've said, what is the likelihood that this is going to result in lower tariffs? And they say Donald Trump is tariff man. He wants tariffs. He wants the walls up. This is part of bringing manufacturing back to the United States. Have you seen anything credibly that makes you think that there will be some sort of grand deal where tariffs will be taken down and it will be true free trade?
No.
Okay.
Totally fair counter argument. I'm not saying that's going to happen. I'm saying I could make the argument. I'm not saying I believe it. But very quickly about that point, yes, I think it depends who you talk to in the administration. You guys surely talk to more people in the administration than I do. But you either believe that tariffs are a mean to an end, i.e. I want to get some behavioral changes from my trading partners, or you believe there's some national security issues at work here, in which case there's almost nothing anybody can do, particularly China, to counter.
I guess that what I'm trying to get at is, from a market perspective, have you gotten less confident in your bullishness as these discussions go on, and as you really question whether the genie's out of the bottle? That, yeah, you can say what people should do, but what they're going to do is going to be very different based on the sentiment that we're seeing in certain countries.
Have I gotten less bullish? I mean, listen, like anybody else, market action sort of controls my emotions. So to some degree, with the S&P down 10%, maybe I'm a touch less optimistic. That said, I look at Mexico's behavior at the border in terms of meeting some of the demands, in terms of cracking down on border crossings, et cetera, et cetera. Canada is obviously choosing to be a little more obstinate, but you look at what Colombia did and a couple of other countries in Europe are. I think there's room for a middle ground here that isn't the worst case scenario. And while I agree that the administration, particularly the president, doesn't appear likely to want to cause a recession, I think he's willing to endure some short-term pain. But again, if you can reach an agreement, a reasonable agreement among parties, then some of these worst case outcomes are not going to come to pass. And I think it's going to be much like the first administration, which was admittedly a different environment, where the worst case outcomes also did not come to pass, and actually the equity market had a pretty good run.
But Dan, the first administration was focused on China.
I get it.
This time around, they're focused on a dozen countries, everyone. And there are knock-on domino effects of that. Okay, so maybe one country acquiesces, but France is talking about an anti-coercion instrument that you were talking about. The Wall Street Journal editorial board this morning came out to talk about. They might not acquiesce. The domino effects of that could hit margins.
Yeah, without a doubt, and this is why everyone's trying to find high margin, high pricing power type companies to insulate themselves from this environment. I'm not saying that everyone else is insane, and my scenario should be everyone's base case.
They might be.
By the way, definitively, at least half of them are insane.
You tell them.
What I'm arguing is there is an optimistic view here that doesn't get as much airing as some of the worst case prognostications. And again, I understand the broader implications here. I think there's a very good scenario that the market, I had been of the view since the January CPI report released in February that we trade sideways for some period of time. Obviously, the market then sold off 10% immediately. I didn't get that, but we're off 4% off the lows. I think it's just as likely that you trade sideways for another couple of months as it is that we fall into a recession.
The conference board yesterday, they talked about the write-in comments and how it's all about the current administration's policies, both positive and negative, and how that's dominating what consumers are thinking. So if consumers constantly hear tariff talk, could that not just be a self-inflicting crisis?
I think that's exactly correct. If you open up the Wall Street Journal, the New York Times, the USA Today, whatever anyone reads, all they're hearing is about how bad.
This might not end on April 2nd.
It definitely does not end on April 2nd.
Yes, so this could be months or years of that. How much damage does that cost?
Well, at some point, people will move on from the conversation when eggs are not $12 a dozen. I think but that's an important point. We've already seen multiple delays to multiple parts of this conversation. Why can't I continue to have multiple more delays? Again, I understand the difficulty that this conversation has for the consumer and for the economy. I'm just simply saying I don't think these worst case outcomes are coming to pass.
Over at Solus, are you leaning into some of the pro-growth trades then, betting that people have gotten a little over their skis with this severe downturn in growth that on the margins is slowly getting priced in?
That's not exactly what we do. What I would say is we have been long energy and have remained long energy. We have faded the idea that global growth is going to somehow suffer in a meaningful way to impact energy demand in a meaningful way. And obviously, at least this year, that's proven to be a pretty good trade, energy being the best performer in the S&P 500. And we still have a couple of consumer-related trades that have held up well. And again, we talk about this every morning, what these companies have to say. I come back and I report, this company said X, this company said Y. Obviously, we're aware of what the home builders had to say. And I don't mean to suggest that EPS estimates haven't come down for basically every retailer. They have. But again, when you listen to some of these comments, Dick's Sporting Goods, when asked about this, said absolutely not in terms of a change in consumer behavior. That wasn't yesterday, it was a couple of weeks ago, but still, you're still seeing a consumer that's doing okay. And I don't believe the administration is willing to push this all the way into a recessionary environment, even if your goal is to reshore steel manufacturing and bring shoe construction back on shore. I'm not sure they're willing to risk a recession for that.
Just to build on that, there's something almost unbelievable about the consumer sentiment data of the last 24 hours. To see it below the levels of where we were back in 2022, when inflation was approaching double digits and federal interest rate hikes.
But let me interrupt for one quick second.
Please do.
The counter to that, as Annmarie surely knows, right track, wrong track is doing very well. When you poll people about the administration's policies,
they like them.
They like them. And again, the right track is the highest since 2009, and before that, 2002, something like that. Clearly, something is, at least in the short term, and a lot of this has to do with dissatisfaction with the previous administration, but clearly a chunk of the country thinks things are going well. There is worries about the impact of inflation and what that's going to do to my purchasing power. We're in a much higher inflation environment now than we were during the first administration. But again, if you start to get meaningful price hikes such that bulldozers are pulling up to the Federal Reserve, I imagine you're going to get a change in policy.
I think there's been some notable developments over the last few days, not just from the President and the White House, but from the Treasury as well. Listening to Secretary Besant over the weekend speaking to the All In podcast, making the case that actually you should pay attention to the sentiment surveys because the previous administration were gaslighting the public. I think that tells you they are taking things more seriously than
100%.
maybe we were led on to believe by the administration themselves over the past few weeks.
I would agree with that, which is the reason why there's been this real shift in tone. What they're willing to do with that, though, is another question, especially given that they do want to announce something pretty significant on April 2nd, and they're dueling entities within the White House, and that, I think, is what we're trying to get a handle on.
Dan, you're going to stick with us, I'm pleased to say. Dan Greenhaus there of Solus Alternative.
2 segments.
Asset Management, a whole 2 segments. Bonus round. Let's get you an update on stories elsewhere this morning. This is your Bloomberg Brief where you have to be quiet for a couple of minutes, all right? Going to be OK? Canada and India looking to resolve tensions and strengthen trade ties to counter US tariffs. Sources telling us here at Bloomberg both nations are considering sending back envoys after expulsions. And a meeting between Prime Minister Mark Carney and Indian PM Modi is possible at the G7. President Trump is backing his national security advisor, Michael Waltz, as the administration investigates a chat leak. Waltz taking responsibility for the breach after an Atlantic editor was added to a Signal group chat discussing military strikes in Yemen. And finally, 23andMe users scrambling to delete their genetic data saw technical problems due to a flood of website traffic. While some users were successful, others were locked out of their accounts. This last line is scary. Genetic information will be part of the company's bankruptcy auction in May.
That's almost disgusting as part of scary.
Goodness me. That is your Bloomberg Brief. Up next on a program, Trump's tax plan coming together.
There's no daylight between House and Senate Republicans. We are one team. We have to bring stability to the markets. We've got to make sure everybody's tax rates are locked in, and they know that. I have been pressing very hard, very aggressively to get the reconciliation bill done by late spring.
That conversation up next. We'll head down to the nation's capital and catch up with Bloomberg's Tyler Kendall from Washington, D.C. From New York City this morning, good morning. Equity futures just about unchanged following a 3-day run of gains on the S&P 500. We are negative elsewhere, down about 0.1% on the Nasdaq. And a negative mood still on some parts of Wall Street. Barclays cutting its target on the S&P 500 for year-end 25 to 5,900 from 6,600. The base case assumes that earnings will take a hit as tariffs contribute to a material slowing in US activity. They're keen to point out we will avoid recession, but a hit to activity nonetheless. Equities down just a little bit softer across the board. Under surveillance this morning, Trump's tax plan coming together.
There's no daylight between House and Senate Republicans. We are one team. We're all united on the mission. I don't fault the Senate. I think the timing is very important because we have to bring stability to the markets. We've got to make sure everybody's tax rates are locked in, and they know that. I have been pressing very hard, very aggressively to get the reconciliation bill done by late spring.
So here's the latest this morning. Republican leaders nearing a plan to extend Trump's 2017 tax cuts and lift the debt ceiling. This ahead of the Senate's goal to pass a budget resolution by the week of April 7 to outline the cuts. Bloomberg's Tyler Kendall joins us now for more. Tyler, what is the timeline? How long is this going to take?
Well, John, we have to put some cautious optimism in this, that there is still deep divisions, particularly among those top line numbers when it comes to where lawmakers are going to do those spending cuts and those tax cuts. And that could impact the timeline here. You mentioned Leader Thune has outlined that he would like to see his chamber pass that budget resolution by the week of April 7th, potentially teeing up a broader vote on the package by Memorial Day. But that is considered to be a very ambitious timeline, although it's no surprise where that pressure is likely coming from, particularly from where I'm standing, since we know this White House would like to get more cash into consumers' pockets and quickly in order to offset those tariff uncertainty concerns. Now, when it comes to exactly what they need to do going forward, perhaps the most optimistic point that House Speaker Mike Johnson made was that it appears that his Senate counterpart, Leader Thune, is coming around on the idea of increasing the debt limit as part of this package. We know that was a big sticking point here, but those top line numbers still need a lot of negotiations. Of course, you'll recall the potential $2 trillion in spending cuts that the House budget blueprint has floated. We know that for some Republicans, there are concerns about what that could mean for programs like Medicaid. But among other Republicans, there's concerns that that's not enough, particularly to offset a potential debt ceiling increase. And then that doesn't even begin to address the tax cuts, $4.5 trillion in planned cuts. As you well know, that's likely only enough to extend the 2017 tax cut plan, not to make it permanent, as this White House would like to see. And it doesn't even begin to address all those other tax cut priorities from the campaign trail, like no taxes on tips, overtime pay, Social Security, or lowering the corporate tax rate for those companies that move production to the U.S.
Yesterday, Tyler, we heard from Senator Ron Paul, who said they've lost me. This is an individual who's never going to vote for reconciliation if there's an increase in the debt ceiling. What are the biggest hurdles in the Senate when it comes to some of the personnel?
Right, exactly. And we have to keep in mind that this is also going through the reconciliation process, which means that Republicans need simple majorities to pass this. But that means every vote is going to end up counting. We are expecting the Congressional Budget Office later today to release their projection of the X date. There's a lot of weight put into this. So far, that projection has been put to midsummer to early fall. So we'll have to see where that shakes out and how Republican lawmakers on the Hill respond to that. The biggest focal point here is going to be whether or not they are going to enact more spending cuts in order to offset these concerns that we are seeing from lawmakers. And you asked about the Senate. I'd also point out in the House Speaker Mike Johnson really can only afford to lose one vote when it comes to this. And I already have a list of lawmakers I can think of that will likely raise some concerns here, whether that's from the House Freedom Caucus or those Republicans representing SALT districts.
Tyler, appreciate your time as always. Tyler, in front of the White House down in Washington, D.C. Let's extend the conversation. Bonus round with Dan Greenhaus of Solus Alternative Asset Management. Dan, let's continue the conversation that we picked up with Tyler just there. Is it sufficient for equity bulls just to extend current policy in a tax plan?
I think so. And we've talked about this in the past. I don't think a lot of the other stuff gets passed. No tax on tips is $100 billion. No tax on overtime is $750 billion. No tax on Social Security benefits obviously is going to disproportionately affect higher income earners, so I think there's going to be some political pushback to that. So I always felt like this was already very expensive, and so adding some Christmas tree stuff to it was probably going to make it a bridge too far. So I think just an extension is more than sufficient if the economy is holding up and the job market's holding up.
But isn't that already priced in?
I think the assumption is that the extension is the minimum that you can expect. That's right. I think that's my base case. But yes, if you're the market, anything less than a complete extension would be a shock.
Well, we were talking to Libby Cantrell of PIMCO yesterday, and she talked about steamed vegetables, the tariffs, and then the excitement, tax cuts being the Sunday. But you already have the Sunday. It's priced in. It's the extension of TCJA. So now you're dealing with a composition of policies where it's skewed towards the negative.
Yeah, this is the big problem that we have in the current administration, unlike the first administration where I guess we'll call it the candy came first, the tax cuts and the cauliflower or whatever came, although I do like cauliflower, came later.
This has been the debate of the moment, whether we should call it the vegetables or not. But carry on,
Lisa
please.
likes vegetables, too.
What do you say? I eat cauliflower for dinner. Just a head of cauliflower roasted, a little bit of salt.
This took a turn.
Put a little carry on it. It's nice.
Which we're bringing in new viewers from the Food Network.
All right.
So yes, I mean, the inverse of the policies this time around has been a big problem for markets. But that said, is it already priced in? Yeah, probably. I've been on the other side of this debate. Everyone keeps talking about tax cuts. This is not tax cuts. This is just an extension of already existing policy, which on its face is not necessarily bullish for the economy or markets, other than the fact that you've reduced the uncertainty.
Right now, I'm looking also at the potential for bond markets to really pick up on some of the deficit that will be incurred from what we're expecting to see, considering that there really isn't the appetite for Medicare or Medicaid cuts as well as Social Security. At what point does that become a liability?
I don't think so. I mean, listen, if DOGE gets around to, the government itself tells us that there's hundreds of billions of dollars of fraud, waste, the magical fraud, waste, and abuse in Medicare, Medicaid, and Social Security. So I don't think you need to cut benefits, at least at the outset. You don't need to cut benefits. If you can get in there and do even a fraction of the supposed hundreds of, and listen, if the government's telling me it's 200 or 300 billion, it's probably twice that. But if you can get even some of that fraud, waste, and abuse out of the system, that's enormously beneficial from a debt issuance standpoint, from a taxation standpoint, from just a holistic standpoint about what you're trying to accomplish. And again, I know DOGE hasn't been met with universal acclaim thus far, but if you can get some of that fraud out of the system, that's an incredibly powerful tailwind to the efforts to sort of streamline the government.
A reason to be bullish bonds?
Treasuries?
Yeah.
Well, yes, to the extent that issuance would be meaningfully. I mean, listen, I know people who think you're talking in total $1 trillion of fraud, waste, abuse throughout the entirety of the government, whether it's defense, Medicare, Medicaid, firing parks workers who are letting people in through the gates. Like, there are people who are pretty optimistic about the level of just total wasteful government spending. And someone used the phrase eye-opening with respect to the USAID stuff and how much stuff we're funding around the country, whether you agree with plays in Bolivia or condom distribution, wherever it actually might be going on. Even if you agree with that policy-wise, there are a lot of people who think, okay, given what's going on, is that really money we should be spending? And if you bring that back home, this is billions upon billions upon billions of dollars. So yes, it's a reason to be optimistic treasuries, especially in an environment where the Treasury Secretary is telling you, I want lower Treasury yields.
This story's changed so quickly. We came into 25 with 10-year yields pushing 5%. We were talking about extra supply, big tax cuts, and all of a sudden we're talking about completely the opposite and lower bond yields.
And the reason why is because of Scott Bessent and his focus on the 10-year yield. And I would say single-handedly, that's the entirety of it, because you take off the potential extension of maturities, you take off the table the fact that they're going to just sort of increase the deficit ad nauseum because he is going to take the reins. Question is how they do that. I understand some of the discussions around fraud, et cetera, but Libby Cantrell said all of those cuts get put back into the agencies for 5 years and won't necessarily count toward deficit reduction.
Because Congress has the purse strings, and once Congress already decides to have funds, put funds towards specific programs, then the funds go back to Congress. They are the power of the purse, but maybe they could put towards other provisions and policies.
Politically, and I stress politically, I struggle to see how they go into the midterms next year, just extending current policy. The pressure to do more of that is going to ramp up over the next few months for sure. Dan Greenhaus of Solus Alternative Asset Management. Dan, good to see you, sir, as always. Up next, Chris Maher of OceanFirst Bank on the impact of tariffs on small business. From New York, this is Bloomberg. Equities just about unchanged here on the S&P 500. We have had a change, though, on Wall Street. A couple of changes in the last 24 hours. HSBC and Max Kettner downgrading equities to underweight, US equities. And then Venu Krishna out of Barclays cutting his price target on the S&P 500 from 6,600 to 5,900 off the back of the tariff changes we've seen. And the earnings hit that he anticipates. Equities down on the Nasdaq by about 1/10%. Should we get you some movers? Let's do that now. Your morning movers with Danny Berger. Hey, Danny.
Hey, John, happy to bring them to you. Tesla down this morning, more than 1% the pre-market. Look, it could just be because this stock has been on a 5-day winning streak. But interesting moves coming out of Canada yesterday. The government announcing that Tesla would no longer be eligible for EV rebates. And any rebates currently in the system will be frozen. They're directly tying this to tariffs, saying that Elon Musk's company won't be eligible for them until they end what Canada calls the illegal and illegitimate tariffs placed onto them. Now, a kind of similar story when it comes to governments potentially using companies as fodder in the trade war. This coming from China on Nvidia. Nvidia shares down 1.5% in the pre-market. The FT reporting that they have environmental rules that would prohibit the use of Nvidia chips that are eligible to be sold in China. Now, these are just rules. It's not clear how strictly this ban will be enforced, but if it is, it will remove a huge market for Nvidia. Finally, wrapping things up with some earnings. We had Dollar Tree out about an hour ago. They did miss, but you'll notice that shares are higher, and that is because of a journal story, higher by about 4%, I should say. A journal story is saying that they are looking at selling one of their businesses, Family Dollar, for about $1 billion. They're in the midst of a turnaround. A lot of competition has been weighing on them, so investors liking that one, John.
Danny, thank you. The stock is higher by close to 4%. Let's get you some top stories. On our radar this morning, Republican leaders saying they're close to agreeing on a plan to extend President Trump's 2017 tax cuts and increase the debt ceiling. House Speaker Mike Johnson saying his Senate counterparts are, quote, coming around.
So they're singing from the same tune when it comes to reconciliation, potentially getting this track on schedule. What I find so interesting is now that the debt ceiling can be potentially roped into reconciliation, it means that they have a pretty firm deadline. It has to be done, even though the House is talking about Memorial Day. Everyone thinks that's very, very quick and almost too fast. But it has to be done by the middle of the summer, or at least by September, if you're going to include the debt ceiling in it. And this is getting a lot of wins from the White House. This is what President Trump wants to see. So potentially there's going to be a ton of hurdles they need to get through with individual senators or congressmen and women that they need to get on board. But the timeline could be by September that they will have a deal in place to extend TCJA.
And the baseline is that this deal would increase the deficit by $3 trillion over the next decade and includes about $2 trillion of offsetting cost-cutting measures, including to Medicaid and to Social Security, which is something that a couple of senators cannot get on board with. How do they reconcile this? Does it come at the expense of a deficit? And will the bond market perk up? Or will it come at expense of the popularity of a number of different representatives?
If this moves quickly, I think we'd all be pleasantly surprised. I'm not sure how many people actually think it will.
I think it's going to be months, not weeks. I mean, they're thinking maybe the end of May. That seems incredibly fast. At the same time, though, you do see the Treasury Secretary really focused on this. He's had a number of meetings, whether it's the Treasury Department going up on the Hill, getting this group together and making sure they get this over the finish line. And then, of course, you're going to have the chief whip coming from the White House. President Trump is going to make calls himself, I imagine, to get this over the finish line.
Let's get you an update on cost cuts as well. The Treasury planning to lay off a, quote, substantial number of employees as part of Elon Musk's Doge cost-cutting efforts. A spokesperson saying the department is looking at efficiency measures and reversing some Biden hiring decisions.
Look, we don't have a sense of exactly who these people are. And before we really come out with judgment, just to put into perspective, the Treasury has more than 100,000 employees across a number of different agencies, including the IRS, the Bureau of the Fiscal Service, the U.S. Mint, and the Office of the Comptroller of the Currency. So there are a lot of areas that they could potentially be cutting. The key question is, and this, we keep talking about this, is there a plan? Is there something that is systematic to go through and do it with diligence and actually cut the right people? And I think, we just don't know.
There's certainly a cost associated with some of these cuts. Take a listen to this. China replacing funding for 2 former US aid projects in Cambodia, cancelled by the Trump administration, totaling $40 million. The State Department saying the US is focusing on funding aid programs that make Americans wealthier and more secure. There is a cost, and it's not financial. It's influence.
It's about soft power and who is going to immediately step in and already stepping in to fill that void. And of course, it's China. And what we're talking about with these programs that were happening in Cambodia, this is about child literacy, and this is about nutrition, improving nutrition and development of children under the age of 5. You have to ask yourself, is this consistent with a very tough policy stance when it comes to China when you're ceding some territory in terms of influence to Beijing?
This just shows the need for nuance. You can say that there are a lot of programs that should be cut that maybe don't necessarily engage with soft power for the United States. There are other programs that are very important, and that is sort of the question around, is there some sort of accountability and a sense of method to exactly where these cuts will be executed?
That's the opportunity right now in Washington, I think, for the Democrats to make the argument that you've just made. Instead of having a wholesale opposition to what they're doing, say, yes, you're right. This is where me taxpayer money shouldn't go. And you'd find agreement with the taxpayers right now. You see that in the surveys. But then you can also point out, well, this is also areas where it needs to go, and this is why. Because if you want to counter China, this is what you need to do. And here's a real example of that happening in real time.
And you can see it around the world. China's trying to fill that void in a number of different places. Of course, the Democrats are so beset with internal disagreement that they can't come up with some sort of main argument about whether to go hard against the Republicans or whether to take a more moderate negotiating stance. So, maybe they should, but they probably...
You know how this works. The rule book for Democrats right now, everything the orange man does is bad. Okay?
Yeah, so, that seems to be the tone.
Let's turn to tariffs. OceanFirst Financial CEO Chris Maher saying, while the direct impact on businesses isn't concerning at present, the volatility and uncertainty is clearly evident. The longer the period of uncertainty, the more likely the perceptions translate into reality. Chris joins us now for more. Chris, good morning.
Good morning, John.
Been too long. It's good to see you again, sir. Yeah, let's start with the reality, your reality in your business at the moment. What do you see?
It's interesting because we'll read about tariffs. Our clients are not particularly concerned about them. And I think you have to look from their perspective. They've been through the first Trump administration, and they have been through COVID. So I like to say our folks got a PhD in supply chains during COVID. They figured out, I have remarkably small businesses that bank with us. We cover clients between Boston and Washington. I have a pet foods business. This guy can explain to you the supply chains in China, Cambodia, Vietnam. He understands the tariffs. He knows where he's going to get his stuff. And it is not looming large in their minds. So it's more the perception than the reality.
It's hurt sentiment. We see it in the survey at a consumer level. We're having this debate about whether it's hurting activity. So these companies that came into the new year with investment plans, with hiring plans, are they on hold or are they going forward with them?
They're on hold. They're a little bit cautious and concerned. They want to make sure they see how things kind of pan out. You talked about the continuation of the tax cuts earlier, right? For those customers, these are higher income households that own these businesses. They're trying to figure out the whole puzzle. So it'll be okay for a little while. We have days, we probably have weeks, but I don't think we have months before that confidence starts to impact the economy.
I want you just to elaborate a little bit further on the point that John was making. There was an estimate of some of the small business confidence, a survey that showed just 19% of small business owners in February were planning the capital outlays in the next 6 months, which matches the lowest level since April 2020. How do you match that with what you're telling us that actually they're okay, they're taking it in stride? Is there a sense that they really are going to re-engage with all of those capital outlays immediately within the next 6 months as soon as there is some clarity?
Lisa, I think that these small business owners, right, the company and their own personal financials are really closely tied. So they tend to be more cautious. They built up liquidity since kind of COVID happened. They understood the uncertainty. They have plans. We're talking about plans. Loan pipelines are improving and increasing, but there is a range of hesitancy around some of kind of the edge like residential construction is an area where people are kind of holding back. They want to make sure that we don't kind of head into a recession. There isn't a demand issue down the road. So,
are they concerned about the competitive advantage that they have versus large companies, given their negotiating position with potential contractors, with potential supply chain dealers? We hear about Walmart going to China and saying, guys, lower your prices. And they can do it because they're an 800-pound gorilla. And even they're getting pushback. I mean, how much is that a real issue for your clients?
It is an issue, Lisa. It's in a very different way. So I'll use the home building example. So we work with some of the largest home builders in the country. They can stock warehouses full of appliances, so they're just kind of immune to where the appliances come from. But in a different way, the small builders just move where they're buying stuff from. So, GE Appliances has a pretty strong U.S. domestic manufacturing base. So they're going to buy GE instead of some other brands. Some of the other brands have a bigger base in, say, Canada. So the small businesses are more nimble. The big businesses are able to do kind of more bold supply chain things, stocking up inventories and kind of planning ahead.
Are materials going up? Are they already seeing those price effects?
Sure, Annmarie. They've gone up. Lumber's gone up 3 different price hikes in the last couple of months. So lumber's certainly up. You're seeing anything with steel or aluminum. Although I'd make the comment that we tend to talk about steel. For our clients, there's like 50 different kinds of steel. Some steel is going to be an issue. Other kinds of steel are not. And although we're talking with many international parties, steel can be sourced from South Korea, can be sourced from Latin America. So there's a very interesting kind of subset as you get under the covers and look. For one company, steel may matter. For another company, it doesn't.
I was speaking to the head of a toy manufacturer, and he was saying, well, it's not that big of a deal because we can kick up prices. And if people are buying a doll, they can pay an extra $2 and they don't really care. Do your business clients feel the same way, that they can really pass it mostly along to clients?
Generally, no. They're very concerned about passing it along. Although we're starting to see contracts now have language in the contract that would say, we're going to pass along the price increases. So generally, no. There are some cases that we have a special metal manufacturer. Their products go into jet engine turbines. We need them. So yes, the price is going to go up. It'll be a small increase to a bigger part of a larger engine. So they're just going to have to raise prices.
But this is where the rubber meets the road. They increase prices. Are you hearing direct feedback that consumers are unwilling to absorb those higher prices?
I think in consumer products, you're seeing substitution. So people are choosing one thing versus another thing. We have a seafood supplier. They get snow crabs, right? So they get them from Canada. They have already told us if the tariffs go in, they're not going to sell snow crabs. You'll be eating something else. So you won't notice that your menu has changed, but the snow crabs won't be on it because they're just going to go up to a price that restaurateurs are not going to want to buy.
Hey, Chris, this was an important conversation. Let's do it again soon.
All right, John.
Chris Maher of OceanFirst Bank. Really some clarity there as to what's happening on the ground in reality, not just the sentiment surveys, but what people are actually doing and not doing.
They might be conservative with their own finances, but they're not, losing their minds. They're not saying, okay, this is it. We're going to close our business and we're really going to suffer some sort of recession, which indicates really what people in markets are looking through. They're saying, okay, sentiment's bad, but we can all rant online. It doesn't mean that we're going to go into recession.
There's a difference between hiring, pausing and firing. And at the moment, we're somewhere in between, pausing. I hope we flip back to hiring. All that confidence we came into 2025 with, I hope we get back to that place. The next stop for this conversation, really, once we get through jobless claims tomorrow morning, payrolls next Friday. If you want a sneak peek right now in our survey, 151,000 a previous number, 120 is the median at the moment. Only a handful of guesses so far, but 120 is the median estimate at the moment.
The difficulty is if you get a number that goes one way or another, if it is a downside surprise, it will have a material effect. If it is an upside surprise, then people will get the sense that there is still a momentum, but it won't clarify the uncertainty. Key question for me is this, and Chris was addressing this and other guests have as well. It is a months or years kind of thing. If it's a couple weeks, it's not a big deal. A month, we can get through it. 2 months, 3 months, it starts to change.
Max Kettner, HSBC, thinks it's too late already. That's just one view. That's his view. Equities right now on the S&P 500, just about positive. We're basically unchanged this morning. Let's get you an update on stories elsewhere. Here is your Bloomberg brief. Vice President J.D. Vance and his wife, Usha, revising their Greenland travel plans as a U.S. envoy travels to the territory later this week. The Vances will no longer visit more populous areas, instead travelling to an isolated U.S. military base. Elsewhere, oil edging higher as an American Petroleum Institute report shows a large decline in U.S. crude stockpiles. The market also weighing a Russia-Ukraine ceasefire in the Black Sea, even as the Kremlin seeks sanctions relief and other preconditions. And finally, Wall Street bonuses surging in 2024. The total payout pool jumping to a record $47.5 billion, the largest on record since 1987. The average annual bonus rising by almost a third to just over $244,000. That's not bad, Bramo.
I would agree with that, and I wonder how much that's going to single-handedly lift the New York City economy. I was actually looking at the data, and you could see that the pop was entirely from that. So you have to imagine.
What would be even better for some of these Wall Street bonuses if there was no tax on tips? You consider that a tip.
Are we going to consider that a tip?
You could. That's where the legislation gets difficult.
Let's see if they even make that push to try and get those taxes on tips removed, because from what we've heard over the last few months, maybe that's going to be pared back.
Yeah, they're throwing a lot of cold water on that. Most people just expect an extension of TCJ. I'm just saying, if you were to have no tax on tip, you have to then outline what is a tip. And a bonus for many people would be considered a tip.
That right there is your Bloomberg brief. Up next on the program, falling consumer confidence.
We've seen a really large and pronounced pullback in both business and consumer confidence.
It's a state where it's not as robust as it had been, and consumers are discerning.
Up next on the program, the team behind the survey, Yelena Shulyatyeva of the Conference Board from New York City. This is Bloomberg. Three-day winning streak on the S&P 500, attempted to make it day 4. Equities at the moment just turning positive on the S&P, just about unchanged on the Nasdaq 100. Under surveillance this morning, consumers pulling back.
The consumer data is not good.
We've seen a really large and pronounced pullback in both business and consumer confidence.
If you think about what's going to end up driving consumer spending, it's not savings, it's going to be job growth and wage growth.
If those higher end consumers started to cut back, that would have a significant effect on consumer demand.
It's a state where it's not as robust as it had been, and consumers are discerning.
So here's the latest this morning. US consumer confidence falling to the lowest level in 4 years. The Conference Board's gauge of confidence decreasing 7 points to just below 93. Yelena Shulyatyeva of the Conference Board joins us now for more. Yelena, good morning. Good to see you.
Good morning.
It's unbelievable just to sit back and think that consumer confidence now, based on your survey, is worse than it was in 22, when inflation was approaching double digits and interest rates were skyrocketing. Are things that bad?
I think confidence indicator is really showing you what's going on in the economy. Consumers are concerned. They're concerned about their financial situation going forward. And this is, to me, is probably the most concerning signal from the survey. Because if you think, well, you're not going to be able to afford this and that, you're going to pull back on your spending. And we do see that in the hard data already, I think. So the previous release of retail sales, right, we saw a rebound from a very bad January number in February. But where was it? It was in online spending. It was not in discretionary spending. And I think consumers are pulling back from the things that they don't necessarily need to buy.
So we've had some downgrades on Wall Street on the equity side. We heard from Max Kettner of HSBC in the last hour, who expects the soft data to bleed into the hard data, underweight US assets. Venu Krishna of Barclays cutting his target on the S&P 500 down from 66 to 5,900. He sees a similar thing, but thinks we can avoid recession. Where are you now, and what kind of hit to the hard data are you expecting in the months to come based on what we've already seen in the soft data?
I'm very much within that kind of view that we're going to see a significant slowdown in the economy, but we will be able to avoid the recession. The consumer fundamentals are still very strong. You're still paying mortgage payments at the rate that you were able to lock in before the crisis. You still have debt to income ratio at a very low level. So consumers are actually in a good place right now. It's about their expectations that we may see a temporarily pullback in spending. The key here is obviously how long uncertainty lasts, and uncertainty has a very profound impact. It could weigh on consumer spending, it could weigh on growth if it persists. So we'll see about that, and obviously next week will help us tell us about that.
It could affect what they do. It could not. It seems like people's feelings have gotten kind of noisy post-pandemic, and it seems like a lot of people in markets are increasingly dismissing people's feelings and saying, yeah, you can feel terrible, but you're not actually doing anything about it. You're still going out and shopping. How do you explain this discrepancy, this increasing discrepancy in the way people feel in some of these surveys, and how it translates into hard data, especially in the past couple of years?
Well, there's a lot of discrepancy within the consumer, right? So we talk about consumers, one entity, but it's actually like lower end consumers and like high income consumers. And so far, a lot of consumer spending has been driven by those who have a lot more dollars at their disposal. So what was concerning in our survey, actually, is that we saw consumers' expectations about the stock market declining quite significantly. So we saw a lot of volatility in the market, obviously. The cutoff date of the survey was March 19th. There was a lot of volatility before that. So consumers took a notice, and probably the wealthy consumers also took a notice of that. So if we see that pulling back, that's not going to be good. Another interesting thing about this particular survey in March was that consumer confidence among those 55 and older saw a very significant decline. So those are who spend on services. So goods will be affected by tariffs. We know that. consumers will probably pull back from more expensive items. But what happens if we see consumers simultaneously pull back from services spending? That's not going to be good.
This is fascinating, the whole idea of the consumer being sort of sliced and diced in these different groups, and the fact that the wealthy consumer can keep spending and support the averages. How much are you seeing the breakdown, according to partisanship, really affecting the average as well?
Well, the conference board surveys well represented across ages, income levels, and obviously political groups. So I would just leave it there. It's representative. I would say that we see a decline in confidence across the board.
But can you give us a flavor of whether or not it's Democrat or Republican when they talk about their concerns? Aren't a lot of these stemming from policies in Washington?
Absolutely. When you look at write-ins, and we do look at those, tariffs are front and center. Inflation is front and center. So another thing that comes to mind when we look at the write-ins is that uncertainty, that word, that new buzzword has been mentioned in quite a lot of write-in responses, much more than in the past. And again, going back to the uncertainty impact, I think that is probably weighing on growth now more than anything else. So we recently downgraded our GDP projections, and this was one of the key factors, not necessarily tariffs themselves, but uncertainty about where it will all go.
What's your GDP number now?
So we're at 1.5% year over year at the end of this year, and the impact of tariffs and all of the uncertainty is actually creating a much more significant impact on growth in our projections than it does on inflation to the upside.
So just to get into that, you haven't revised your inflation outlook higher at the same time.
We did.
You've done that too.
We did, but to a much lesser extent. So the idea is that growth will subside much more significantly, and that will put downward pressure on inflation.
Do you think, given the magnitude of the revisions that you're suggesting and that we've seen elsewhere, the Federal Reserve can focus on one versus the other?
I think they will focus on growth and the labor market, and that will eventually make them cut.
This is the important conversation I think market participants are having, Lisa, particularly after what we heard from Chairman Powell just last Wednesday.
Yeah, and he let the transitory word out of the bag, and suddenly people said, OK, we can look through this, and they're going to focus on the downside to growth. I'm just interested in the fact that what you're hearing from other Fed officials, the transitory word, Austin Goolsbee, he engaged also with the T word, and he came out and he said, sure, some of these could be, it depends on what they are. So it seems like, maybe, but then others maybe were a little less sanguine on it.
Not hiking is bullish.
Yes.
But at some point, not cutting is bearish. And that's where things could get problematic later this year.
How much can they look through the inflationary impulse to really focus on slower growth? And right now, this market is betting that they will do just that.
Mike Apen of Morgan Stanley over the last week, his line, easier said than done. Yelena Shulyatyeva for the conference board. Yelena, good to see you.
My
always.
pleasure.
Thank you. Up next on the programme, Tony DeSpirito of BlackRock, Drew Redding of Bloomberg Intelligence, Michael Reid of RBC, Subadra Rajappa of SocGen. The third hour of Bloomberg Surveillance just around the corner.
The kind of uncertainty that's being created by the chaotic tariff policy is something that has to give anyone pause.
It's been more the uncertainty around policy that has crimped our forecast.
We will get some clarity next Wednesday. I think the big question is, does the market like that clarity?
The correction in the market is the market telling we don't like these policies or we don't understand these policies.
I think there's a scope for it to be peak policy uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. The opening bell 90 minutes away, and your scores look like this on the S&P 500. Just about unchanged on the S&P following 3 days of gains. Can we make it day 4? Or the Nasdaq just a little softer? Some stability relative to the choppiness of the last few months. And that stability comes from a softer tone from the White House and a move towards a tax plan. down in the nation's capital.
It seems as though there isn't this wholesale, it's as bad as it's going to be kind of rhetoric coming from Washington, D.C. Basically, any day without a tariff headline is a day when people can say, okay, can we get back to the fundamentals? And the fundamentals aren't that bad. What I find most interesting about yesterday and the continuation of the rally is that it's come in despite some of the soft data continuing to be incredibly negative. Increasingly, traders are saying, ignore that. This will end soon, and we can all get on our American exceptionalism bandwagon again.
There's two positive signals coming from Washington. One last night on Newsmax, the president saying, I'm going to be more lenient than reciprocal when it comes to tariffs. And we do know that meetings are underway with massive trading partners for the United States. Second, there's a meeting when it comes to the tax negotiation, and you have Congress and the Senate lining up at least somewhat in the process of how reconciliation and the extension of tax cuts is going to go. The issue is Max Kettner earlier in the program talked about the fact that the damage might already be done. And that is what this White House is up against.
You see that in consumer confidence dropping to the lowest level in 4 years. Consumer sentiment at the moment, heavily influenced by politics, we know that. But based on that headline read, worse than 2022. Just think about that. 2022, when sentiment was rock bottom, inflation was sky high, and the Federal Reserve was aggressively hiking interest rates. Are we really saying that things are worse now than they were back in 2022?
If people feel that way in these surveys, it's the reason why people are maybe treating it with some skepticism in markets, that it will translate into that type of behavior that reflected the same period of time. There are a lot of different aspects affecting this. Even though spending has stayed at an elevated level, Yelena Shulyatyeva was just saying, a lot of that is supported by the wealthier individuals that have really outpunched their weight. You have to pay attention, but the question is, how much do you have to trade on it? And that, I think, is what people have really been grappling with.
I think it matters who's paying attention. Who's paying attention to these numbers? And right now, the administration appears to be paying attention to these numbers. If you listen to a recent interview with the Treasury Secretary Scott Bessent, sitting down with the All In podcast, I took a listen over the weekend. A strong indication that he's taking these numbers, he's taking these headlines seriously. And I think that's an important signal from the administration.
Definitely, especially when this administration ran on things like we are going to bring gas prices and groceries down, kitchen table issues. They don't want to see inflation expectations move higher. And when it comes to an individual like Scott Bessent, this is someone who comes from a macro trading environment. All the data for him matters.
Equities on the S&P this morning, just about positive to unchanged through most of this morning. Coming up this hour, we'll catch up with Tony DeSpirito of BlackRock as stocks look to extend a three-day rally. Drew Redding of Bloomberg Intelligence on caution from home builders, and Subadra Rajappa of SocGen with her outlook for US interest rates. We begin this hour with stocks steadying following a bumpy ride for US equities. Tony DeSpirito of BlackRock writing the following: post-election moves got ahead of themselves. This is a healthy correction. We also see a healthy broadening out of returns. Tony joins us now for more. Tony, good morning. It's good to see you.
Good morning. Good to be here.
I wanted to pick up on this headline from Barclays from earlier this morning. So they've cut their outlook on the S&P 500 from 6,600 to 5,900. They say this: the base case assumes that earnings will take a hit as tariffs contribute to a material slowing in US activity. Just to take a step back, how do you view things from 35,000 feet right now?
Yeah, first of all, I think it's a good perspective to look back a little bit in time. And so I really take a 6-month look or 5-month look and say, look at what happened in the fourth quarter. There was incredible enthusiasm, U.S. exceptionalism, growth over value, cyclicals over defensives, et cetera. And then that's reversed out this quarter. And if you just look over the full 5-month period since the end of the third quarter, basically nothing's changed that much. U.S. versus Europe is about neck and neck. Growth versus value is about neck and neck. Cyclicals versus defensives are about neck and neck. And so what that tells me is things got a little overheated. The market got a little overheated in the fourth quarter, and now it's getting a little bit more conservative. That's why I call it a healthy correction.
So we have seen some dislocations from some major stocks on the S&P 500. Nvidia's still down 20% from the highs. Tesla's still down by something like 40% at the highs. I'm thinking of some of the language you've used in the past to describe temporary dislocations. Dislocations for corporates that should be well positioned to take advantage of longer-term trends. Are those two of those names? What are those companies?
Yes, so I'm not going to get too into specific company ideas, but I do think there's a lot of opportunities in the market today. Dispersion creates opportunity for stock picking, and that's how we look at it.
Stock picking in the big tech sphere?
across the market, actually.
Well, the reason why this is actually important, because we talk about a broadening out, and those are the names, which John just mentioned, that have been hit hardest. And over the past 3 trading sessions, you've seen them rally about 6.2%, and you've seen the equal weight actually decline. And so it makes people wonder, are we going back to sort of a de-broadening out where people hunker down in the Magnificent Seven again? Do you think that's what's going on?
No, I think the breadth is going to continue, and it really goes back to earnings. So if you go back to 2023, the earnings gap, in the growth gap between the Mag 7, everything else, was about 40 percentage points. That's a huge gap in earnings growth. In 2024, that narrowed, but most importantly, it narrowed throughout the year. If you look at estimates for 2025, that gap in earnings growth rate, less than 10%, and it's expected to narrow even more in 2026. That's why we're getting a broadening of the market.
Have you not changed your view at all over the past month, at a time when we're seeing Wall Street pretty much one by one downgrade their growth expectation and nudge up their inflation forecast for the remainder of the year?
So what I think we're in is just a period of policy uncertainty. You see that in the survey data. You see that in the consumer data. You see it in the CEO data. And that's why the soft data is kind of weak. But the reality is, once we know what we're going to have in terms of a tariff policy, I think companies will react, they'll adapt. We'll have some changes in currency. We'll have some renegotiations, some moving of supply chains, negotiations with suppliers, et cetera. Companies will adapt, and then I think we'll go through the period of uncertainty, and then we'll be back off to the races. So I think it's a mistake to be downgrading your outlook at this point.
You think it's a correction because of just where earnings were being priced, where companies were being priced, their valuations, less so about the policy that we're hearing from Washington?
Well, I think it's a combination. Valuations were high. Go back to the beginning of the year, the S&P was trading at about 24 times earnings. So that's high. That combined with some uncertainty, right? So high prices make the market a little more fragile. You get some uncertainty, and you're going to have a correction. But what I see is now prices are getting better. If you look at the equally weighted S&P 500, it trades at 17 times earnings. That's that's a very attractive multiple. And then we'll get through this period of uncertainty. And that's why I think it's a mistake to be downgrading your outlook.
You've seen the money start to go abroad, to Europe, to China, where people were making an argument to put money for years and years and years, and it did not work. Started to work the past few months. Does it continue to work? Is there reason to believe it will work?
Well, I think you have to look at fundamentals, right? And the fundamentals in the U.S. still are the healthiest, both in terms of GDP growth, but also in terms of corporate profitability. One of the things that we pay a lot of attention to is return on invested capital. And return on invested capital for companies in the U.S. is about double what it is for companies outside the U.S. That's on average. It's not every company. So there's certainly pockets of opportunities all over the globe. But on average, U.S. has the best companies.
Given it's no longer the only game in town, though, given that we're seeing technological progress in places like China, we're seeing fiscal progress in places like Germany, does that adjust how much people are willing to pay for U.S. earnings?
Yeah, again, I go back to this 5-month perspective. I think the concept of U.S. exceptionalism is real and true, but maybe that story got overhyped, overinflated in the back half of last year, and now we're just getting back to a more normal level of it.
On the flip side, if you don't see some sort of real drop-off in growth, then all of a sudden there's a question about the bond yield conundrum. And at what point, especially with slower growth, higher yields crimp the overall valuation metric that you can assign equities? At what point do you get concerned at a time where bond markets are looking very closely at debt negotiations and what the fiscal deficit is going to look like over the next decade?
Yeah, I mean, if you look at inflation, it's about 3%. The long bond's about 4.3%. Yeah, that's a decent spread, right? So I think we're probably about in the right place with respect to interest rates. And then you look at an equity risk premium, right? Just comparing the yield on stocks versus bonds. That's pretty normal, particularly, again, go back to the equal weighted, and this is the breadth comment. If you look at the equal weighted index, the equity risk premium is actually slightly higher than historical average. So I think we're in pretty good shape with respect to the bond stock trade-off.
So do you spend all day just basically walking people off the ledge?
Look, our job as investors is 2 things. One is to pick the right stocks, but then 2 is to keep people invested. And that's the long lesson of history. Is don't panic, stay invested in the market. If you miss some of the best days in the market, you miss all the returns.
This is why I've always said they should do a course in psychology if you 100%. Want to work on Wall Street. 50% of it's therapy.
And I can feel it. Honestly, you're coming up with all the things, but it's the right tone. And listen, you look back on history, and it's sort of what I feel is that there's a sense of don't panic, stop it. And I get the sense that that's the tenor of a lot of your conversations.
Well, I think a good investor is someone who's even-keeled. and I think that's incredibly important, is you shouldn't be driven by emotions, you should be driven by facts and data.
You bring that to the programme this morning. We appreciate it. It's good to see you.
Thank
Tony
you.
DeSpirito there of BlackRock. Your equity market just about unchanged on the S&P. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Apple CEO Tim Cook visiting China's AI hub this week, hometown of the AI startup DeepSeek. Cook saying on social media that he met with the, quote, next generation of developers at an elite university in the city as Apple donates over $4 million to the school. Elsewhere, Republican leaders saying they're close to agreeing on a plan to extend President Trump's 2017 tax cuts and increase the debt ceiling. House Speaker Mike Johnson saying the Senate counterparts are, quote, coming around. And finally, New York officials are asking the federal government for more money to fund public transit as the Trump administration threatens to roll back funding. The MTA outlining a $68 billion multi-year plan to modernize its crumbling system and improve service.
Sean Duffy, the Transportation Secretary, going off on Governor Hochul, saying it's outrageous that they're going to need any more money and it's been a mismanagement of their transportation system.
Don't you two usually fight over this issue?
Oh,
Isn't
yeah.
that what
We fight over congestion pricing.
Well, congestion pricing and the fact that, honestly, there are some very beautiful stations, I would just like to say, particularly...
What's your favourite?
Well, the one near the World Trade Center, the one that they rebuilt after
Okay.
it was beautiful. It's really nice. Rector Street, they did a beautiful job. There's some really good ones.
You in PR for the MTA now?
114th Street, they actually have those cute little sculptures. You can go, get some art.
Don't think Anne-Marie's going up that high, but good try. All right. Up next on the programme, the morning calls, plus Drew Redding of Bloomberg Intelligence as home builders signal caution. That conversation up next. From New York, this is Bloomberg. Just want to clarify, you said 14th Street.
Yeah, 14th Street.
Okay, you'll get Amrita to go downtown. I thought you meant north of 100.
No,
Okay.
14th Street, they're like little sculptures that kind of hide behind the different staircases, and they're, oh, cute.
The only reason Anne-Marie's going north of 100 is Yankee Stadium, a couple of times a year.
And Arthur Avenue.
For that's the food. That's it for the food.
And she's taking the 4 line, I know.
Yeah, she'll go downtown to 14th Street.
Yeah, so 14th
Make
Street,
that
so
happen.
check it out.
Be taking the subway, though. That's a different issue.
Misheard you. We can have this conversation another time. I know where it's going, though. Equities on the S&P right now just about unchanged. The opening about 1 hour and 15 minutes away. Let's get some morning calls. First up, Stephen's upgrading CarMax to overweight, saying the company will likely benefit from most tariff scenarios. That stock is up by 1.5%. Your second call from Bank of America, cutting its price target on RH to 410, citing a softer macro picture and discretionary spending concerns. They are not alone. That stock is just about unchanged. And finally, KPW, cutting its price target on KB Homes to 65, seeing weakening in the new homes market. That stock just about stable after getting hit in the last 24 hours, lower after the home builder cut its full-year forecast, saying spring demand is muted. Home builders echoing lower consumer sentiment as the sector braces for tariff impacts. Bloomberg's Drew Redding joins us now for more. Drew, welcome to the programme. Let's just get straight to it. We heard from KB Homes. I'm sure they're not alone. Just how bad are things and what's driving things?
Yeah, so look, we're in the heart of the spring selling season right now. We've had mortgage rates come down about 50 basis points. Expectations were high coming into this year, but that typical spring boost that we normally see has just failed to materialize at this point. You know, everybody's well versed at this point of how weak affordability is. We've had home prices up over 50% since 2020. We've got mortgage rates in the high 6% range, so affordability is really weighing on consumers. But at the same time, what we've increasingly heard from the builders is that a lack of consumer confidence is really holding things back. So, you know, maybe you have people out there who are hoping that rates fall further. You have some who are worried about the direction of the economy. And then you have some people out there who are maybe concerned about, you know, their job security and are putting this such a big purchasing decision on hold. So I think that's something that's maybe underappreciated at this point.
Drew, can you take a step back and talk about what kind of deceleration and expectations that you're hearing from these home builders? What period of time this resonates with, just so that we can understand the context behind this? Is this just a slight slowdown from a really robust pace, or is this something that suggests that consumers truly are just out of the housing market completely?
Good question. So the new home market has been bumping along kind of the mid 600,000 unit pace really since mid-2023. So, it's not that new home demand is doing poorly. It's just we're not seeing that acceleration that we were expecting coming into the year. And, when you think about what's holding back the market, we mentioned affordability, we mentioned consumer confidence, but the other thing you have to look at is inventory levels. The lack of for sale inventory in the existing home market has been a key theme for the builders. There hasn't been a lot of options out there for buyers, which really funneled demand to the new home market, but we're seeing that start to inflect. And if you look at some of the most important markets for the group, like Texas and Florida, we have inventory levels which are well above 2019, which is putting significant pressure on net pricing. And that's really the issue for the builders. They're having to work a lot harder for each sale through either incentives or base price cuts.
This is fascinating, Drew, because at a certain point during the pandemic and the direct aftermath, there just was no supply because the people who had homes and had 3% mortgages were not going to be selling to try to get another mortgage and buy something else. And so there was a stagnancy, and home builders filled that void. They built the supply. Are you saying that some of the existing homes are now entering the market now that we are reaching a point post-pandemic and with rates coming down? Or are you saying that we have reached saturation point with some of the new construction?
It's a great question. I think it's both. On the resale market, you have had that mortgage rate lock-in effect, which I think prohibited people from listing their homes. As we're getting more and more transactions at higher rates, that's gradually starting to fade. But at the same time, you have homes sitting on the market longer. You have more listings coming to market, or perhaps people looking to get out, people looking to get out of maybe short-term rental investments. But like you mentioned, it's not just the resale market. In the new home market, like you mentioned, builders have really been aggressive in increasing their production of spec homes. That's homes without a buyer. And the reason they were doing that is to fill that void that was left by resales. Spec home inventory now is near record levels, so I think you're going to see builders continue to take more caution and take their foot off the gas pedal in terms of new production. So, it's an inventory situation that's impacting both sides of the market.
Drew, when it comes to the home builders, what are you hearing in terms of how they're preparing for potentially hikes on tariffs, or how they're already preparing for things like aluminum, steel facing a 25% tariff?
Sure. So just for a little bit of context, according to the NAHB, the U.S. imports about $13 billion worth of goods used in new residential construction. So that's about 7 to 8% of the market. And of that, you have about 45% of those imports coming from China, Mexico, and Canada. So from China, you think about things like appliances, lighting tools, gypsum or drywall from Mexico. And the biggie is lumber from Canada. About 70% of the lumber that the U.S. imports comes from Canada, and that represents about 30% of all the lumber used in the U.S. Now, for the builders, that lumber represents about 10% of their average selling price. So they're facing a significant margin headwind should tariffs go up another 25%, because you have to keep in mind, we already raised tariffs on lumber imported from Canada to 14% last year. So we're looking at a 40% total tariff. So a significant margin headwind for the builders. How are they addressing that? Some are going out earlier and, locking in lumber prices, buying out a little bit further. But, you can only do that for so long with costs continuing to rise.
And how much can they pass on to the consumers?
Right. So typically builders have had success in passing on higher costs to consumers, but I think we're in a different environment now where buyers have become increasingly sensitive to just how high home prices are. So I think builders aren't going to be as able to pass those costs along. So I think, consumers are going to eat some of it and builders are going to eat some of it too, and you're going to see that on the margins.
Hey, Drew, appreciate your time to break this down. Drew Redding there of Bloomberg Intelligence on the housing market. Things have been really, really difficult to read. You would have thought when interest rates were climbing aggressively, these guys would have struggled. It wasn't the case because we had a supply issue that they could take advantage of. And now you get the sense things are starting to rebalance in a different direction.
It shows just how little control in some ways the Fed and Fed policy can have on the real economy. And I would argue that we thought that the market that would break the quickest would be the housing market. And instead, it didn't. It surged because people who were locked into their homes and had no desire to move because of their mortgage rates left it with no inventory. A question now of whether you could see a real deterioration in home builders without there being commensurate downturn in the economy, because usually that is a leading indicator, and this is yet another leading indicator that seems to be broken in a new era of economics.
This is something that Neil Dutta of Renmark has been on top of repeatedly. over the last few weeks.
Absolutely. And when it comes to what is going on with home builders, when construction workers, anecdotally, what I have heard from a number of construction companies is that they've already had to raise their prices. At some point, if you're in the market for refurbing your home, are you actually going to be willing to pay for that? And how do they plan for the next 3 to 6 months if Trump right now is in negotiating mode when it comes to the biggest trading partners and things like lumber, aluminum, and steel will be hit with tariffs and already are?
The confidence is clearly taking a hit. If you are just joining us, welcome to the programme. So in the last 24 hours, we had consumer confidence. Came in at a 4-year low. You go headline by headline. Doesn't make for great reading. Expectations 6 months out, the lowest in 12 years. Inflation expectations, the highest in 2 years. Expectations about future finances, the lowest since July 2022. That's the consumer. Here's the C-suite, the CFO. This came from Mike McKee just moments ago, and we'll catch up with Mike in about 7 minutes' time. From Duke University, Richmond, Atlanta Fed, CFO survey. Optimism about the economy among CFOs fell in the first quarter of 2025 amid concerns about tariffs and uncertainty. That word uncertainty and tariffs keeps coming up repeatedly.
And what do you do with it, right? And this is sort of the frustration with so many people who come on this show and they say, I have to give conviction. And I'm going to say uncertainty and tariffs and we don't know. Question here about the optimism among CFOs falling in particular. And I'm glad, Mike, thank you for sharing this with us. About falling to what? And this is something Mohammed El-Arian was talking about. You're going to see growth decelerating to what? And at what point, even if it's not recession, does it become potentially problematic at a time where there is a fiscal situation that's potentially problematic? I mean, this is, I think, some of the nuance that people are trying to parse through and getting a little bit twisted on.
So there's 3 stages here. Hiring and investing, stage 1. Pause, stage 2. Stage 3, we all want to avoid it, firing and divesting. Let's hope we don't get to stage 3. But what you hear repeatedly from people when you ask them about these surveys is we're in a wait-and-see mode. We're in pause, stage 2. You can always go back to stage 1. Things can turn around. These sentiment surveys can flip the other way. And if we make the changes we're anticipating down in Washington, this vibe shift we're starting to see, this tone shift, if that sticks, sure, it can flip the other way. If it holds, if we end up with this situation where uncertainty from here just keeps climbing and it persists, then you start moving in the bad direction, and that's not what we want to see.
Especially at a time when uncertainty is pervasive among consumers, and they might not be absorbing some of the price increases, because then they have to cut costs elsewhere, and we have seen measures to do that. I do wonder if we're going to get there. I also wonder the length of time it's going to take that this uncertainty needs to persist before we start seeing those moves.
The CFO survey is interesting because it is the C-suite that will have access to this Oval Office. Donald Trump likes to take the mood of executives. I'm sure Howard Lutnick, his phone has been ringing when Scott Bessent on that All In podcast is talking about that he is paying attention to the consumer survey. You have to imagine executives are calling and saying, I need you to be flexible. I need you to be lenient. The words Trump is using when it comes to tariffs.
In just a moment, we'll catch up with Mike McKee. Mike McKee can break down that survey for us. Plus, breaking durable goods data. We'll get into that in just a moment. We'll get the reaction of Michael Reid of RBC and Subadra Rajappa of SocGen. Live from New York City this morning on a 3-day winning streak on the S&P 500, the longest since early February. Equity futures just about unchanged. Your opening bell 1 hour and 4 minutes away from New York. This is Bloomberg. The opening bell is 60 minutes away. Some economic data just seconds away. Going into that data, equity futures on the S&P 500 just about unchanged. On the Nasdaq 100, negative by 0.1%. In the bond market, yields higher by 2 basis points. The 10-year 4.33, the 2-year just south of 4%. On a 30-year maturity, higher by 3 basis points at 468.63. With your economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're looking at durable goods orders that are much better on a headline basis than anticipated, up 0.9%. The expectation was for a 1% drop. Last month, we grew 3.2% on a headline basis, but that was largely Boeing. We'll see if Boeing figures into these numbers a bit. Durables ex-transportation, though, fairly strong, so maybe not a Boeing story today. 0.7 gain. Capital goods orders, non-defense ex-air, though, that's the one that everybody watches because it's the part that is changes in basically GDP for company performances, and that's down 0.3%. The expectation was for a 0.2 rise, and last month it was up 0.8. So it isn't particularly good news today, in at least what we're looking for GDP. Now, the other point you'd want to make about this is that it does show that in some areas businesses are still spending, but it's slowed, and that fits the narrative with what we have been seeing of the economy not falling off a cliff, but certainly losing momentum.
And losing confidence, Mike. And we saw that with the consumers yesterday, and we mentioned that CFO survey that you sent over to us, down as well. How do you read between the lines, Mike?
Well, according to the people at the Richmond Fed who conduct the survey, what they're seeing is about a third of the respondents are worried about tariffs and what impact they will have on their business. And half of the respondents say they do business across borders with Canada, Mexico, and Asia. So there is some real concern about what might happen in Washington. Interesting note, while most of them thought that growth, the mean forecast for growth this year was 2%, not bad, slower than it has been. We've seen a doubling in their views of whether we're going to see recession, up to 15% from about 7.5%. So there is some concern about what's going on right now in America's C-suites.
Hey, Mike, appreciate the update. Thank you, sir. This came from Kevin Gordon at Charles Schwab. Following the conversation, Kevin, thanks for watching. Pointing out that the Richmond Fed Manufacturing Index 6-month prices paid expectations rose to a new all-time high in March. That's unbelievable, isn't it?
Yeah, we've seen this actually across surveys, that they all expect prices to be going up. And you think about the input prices, particularly for manufacturers, especially with tariffs, at least in the near term, they should go up. One thing to temper some of the pessimism, and I think it is important to note, which is that economic optimism among CFOs fell back to just where it was pre-election. So that's what we're looking at in terms of the potential hit, and optimism about their own firm's financial prospects didn't fall nearly as much.
It's the post-election reset.
Exactly.
We heard that from Tony DeSpirito of BlackRock as well with regards to the equity market. To extend the conversation, Michael Reid of RBC joins us now for more. Michael, it's good to see you.
Thanks for having me.
What's your view on where we are? Because the soft data is dreadful. What's your take of things?
Yeah, so what we've been calling it is uncertainty paralysis. It's just really hard to make a decision right now when you're looking at the data and thinking about what that means for growth. It's that decisions are being delayed, and that means that's going to weigh on what factors into things like durable goods orders, consumption, and that's what we've been watching, really taking a hit here in the first couple months of Q1. And that can have ramifications down the line when thinking about what that means. For example, for the equity market, we've seen a pullback there. One thing we're keeping a close eye on is that high-income cohort, those folks who rely more so on things like dividend and interest income as opposed to wage income. Those folks have really been driving the consumption growth, and that's what's important in terms of the resilience we've seen in the U.S.
Are you saying that if the stock market sells off, and I'm taking a pretty big leap here, that there could be an even bigger read-through in terms of the economic impact, because that could affect the sentiment of the consumers that have been the main actors with respect to upholding the U.S. economy?
Yeah, absolutely. And there, what we've seen is already a divergence in terms of the consumer. So we've talked a lot about a K-shaped economy, wherein low and middle income consumers have already fallen behind. They've really spent all of their savings, and it's really been that top 10, 20% of income earners who have been driving consumption growth. So if you see a pullback, perhaps another 10%, for example, that cohort could start to pull back on their discretionary spending. So we're keeping an eye out on things like restaurant spending. We saw that was relatively weak in the past retail sales report. Things like travel, recreation services, we'll see that on Friday. So those will be really important to watch for in terms of that group.
There seems to be a debate percolating out of Wall Street where you have Max Kettner on one side saying that the likelihood of some sort of permanent hit to growth is already baked in, and he's actually downgrading his outlook for U.S. equities and risk assets. And then you have the likes of Tony DeSpirito of BlackRock saying, hold on, things still look pretty good, and he actually sees a lot of opportunities. Do you think the damage has already been done, or do you think that really this is a could, would, maybe, if this, then this kind of scenario?
It's still very uncertain, right? Going back to this uncertainty paralysis. In terms of the damage to the consumer, I think what is encouraging to us is that we think the labor market remains tight. And that's a demographic story. The huge wave of retirements we saw in 2024, we think that continues here. That comes into question if you do see a further correction in the stock market. Also, now you have the question of how much does the cuts coming from DOGE impact the labor market? We're starting to see that show up in the data. We saw a drop in federal hiring this past jobs report. We'll start to see if that spreads out into other sectors, in particular thinking about things like education and nonprofit organizations that have been affected by some of those cuts.
Can the private sector absorb those DOGE employees?
Some, but not all. And I think what's hard is when you think about the folks who are being let go from the federal workforce, for example, they may not have the skills or they may not be in the right locations to match with the job openings that exist now. One field in particular that we think continues to hire is healthcare, but that's very much an in-person, geographic-centric type of a job that requires a certain skill set, certain amount of training. So that takes time, several years for someone to transition into that type of role.
It points to how tough this rebalancing the Treasury Secretary Scott Bessent is pursuing, how tough it might be in the years to come.
If someone works in the IRS, are they really going to shift into a nursing job in California? I mean, ultimately, this is what we're talking about. How fungible are some of these jobs?
Michael Reid, good to see you, sir. Thanks for dropping by. Michael Reid there of RBC on the US economy. If you're just joining us, welcome to the programme. Equity futures on the S&P 500 shaping up as follows. The opening bell is about 50 minutes away. Equities are just about unchanged on the S&P 500 following 3 days of gains. That 3-day winning streak, incidentally, the longest since early February. That's how choppy things have been over the past 2 months or so. We've had a series of downgrades to US equities over the past few weeks. Equity downgrades in the US from HSBC twice, from Citi once. Price target cuts on the S&P 500 from Ed Yardeni, David Costin from Goldman Sachs, Lori Calvasina from RBC, and this morning from Barclays going from 6,600 to 5,900. Lisa, looking for that tariff hit to hit earnings.
And the fact that you don't have as much of a potential offset. And I think that this is also key. You have tariffs hitting earnings, and it's unclear exactly how much of a sweetener there can be on the other side, especially as some of the debt negotiations and the reconciliation negotiations go on in Washington, D.C.
Joining us around the table, Subadra Rajappa of SocGen. Jumping into the seat. Subadra, good to see you.
Good to see you too.
I've been asking this question we all have all morning. Are things really that bad based on what we saw in consumer confidence numbers in the past 24 hours?
So the hard data has been relatively good, right? You have a relatively strong labor market. Inflation is easing ever so gradually. Even retail sales, even though it was a little bit below consensus, was relatively strong, so the consumer is holding up. But if you look at every soft or survey-based data that you're getting, it's all quite, points to kind of a souring sentiment. So the question is, what's the lag between that souring sentiment and when that actually feeds through to the economy? If you look at, say, the last go-around, the experiences is, after tariffs, it typically takes about 3 to 4 months for that to actually show up in the hard data. But people are starting to incorporate that into their forecast. We saw that from the Fed. They're lowering their growth forecasts. They're increasing the unemployment rate, and they have inflation higher for this year. So all of that points to kind of a stagnating environment. And that's not really great for the markets.
Which is the reason why I think people are struggling to understand the role of bonds with all of this. Are they an offset or aren't they? If you have a slowdown in growth, usually the knee-jerk reaction is to go into duration. This time around, is it?
I think so. I think that when you see the equity markets start to correct, you are going to see bonds perform well. That negative correlation, I think, is very much in play. And you saw that. You've seen that sort of price action over even the last couple of months. I mean, equities have sold off quite strongly, and you've seen bonds benefit from that. So I think that sort of dynamic is here to stay. There's also a lot of other reasons why I think I'm somewhat bullish on bonds. We actually have 10-year yields going to 375 by the end of the year. In an environment where the Fed is going to keep policy on hold and the front end is going to be pegged, you're going to see that rally come in the long end. You're actually going to see flatter yield curves, for the remainder of the year. There's also sort of demand dynamics that could favor treasuries. For instance, if you see a change in the regulatory framework and if there's changes to the supplementary leverage ratio requirements, I think you're going to see more demand, from banks and primary dealers for Treasury. So in that sort of environment, I can see 10-year Treasury yields actually heading towards 375 by the end of the year.
So this actually flies in the face of what a lot of people come on the show and talk about. They say what's going on in Germany, this fiscal expansion, increases the amount of developed market debt globally. You have sticky inflation that is going to remain persistently so. And then on top of that, you have budget concerns, especially given the fact that the deficit is likely to expand by $3 trillion over the next 10 years on the base case for what right now the GOP is proposing in Washington, D.C. How do you just shrug that all off?
So there is, I would say, for the first time in the last decade, decoupling, if you will, between 10-year Treasury yields, for instance, and bond yields and JGB yields. I think bond yields are actually going to go higher because of more deficit spending coming from Germany and all the other countries in Europe. And in the U.S., it's going to be the other way around, where I think Treasury Secretary Bessent is going to want to issue more bills and not as much in coupon issuance sizes. So we actually have the 10-year Treasury bond spread going to 45 basis points by the end of the year. So that's a pretty dramatic narrowing of that spread. And the decoupling is not just between Treasuries and bonds, but it's also between Treasuries and JGBs. So that is, I think, is going to be a paradigm shift for this year.
When do you think he wants to change that issuance? Because so far we haven't seen any changes to what Secretary Yellen was doing prior to him walking in the door.
So I think that they probably keep coupon issuance sizes stable for the remainder of the year, perhaps even to the first quarter of next year. And they probably issue a lot more by way of bills. And what's interesting to me from the last FOMC meeting is the fact that the Fed is basically ended its quantitative tightening program. So they're only reducing their balance sheet by $5 billion, roughly, and mortgages, of course, every month, which means that they're going to be buying more. At some point, the maturing mortgages probably get reinvested into Treasury bills. So that gives the Treasury more room to issue in the very front end as opposed to increasing coupon issuance sizes.
Since we're a week away from tariff day, I wanted to get your thoughts on what you thought the Fed's thinking about tariffs being transitory. Do you think that's accurate?
You know, I'm actually starting to hate the T word because it's really, really
starting.
It's really, difficult to know what's going to happen. I mean, yes, logically speaking, if you see a one-time, increase in prices, that has to be somewhat, transitory. And you're seeing that play out in front-end inflation break-evens. You see 2-year inflation break-evens. You're seeing a lot of that getting priced into the very front end, as opposed to, if we look at, say, 10-year break-evens or 5-year forward 5-year break-evens, those are actually quite low. So the market is also thinking that it's going to be somewhat of a 1-year, 2-year inflation as opposed to something that's more longer term. But I'm not willing to kind of buy into that transitory narrative, because that transitory narrative could be a couple of years.
Just finally, did you say 45? 45 basis points?
Yes. It's a little dramatic.
We're at 155 right now. We haven't seen anything like that since 2013.
Yeah.
It's been a long, long time.
Yep. And that's the debt break rule, right? And what's also interesting to me is that as sentiment sours in the US, sentiment's actually improving in Europe because of the fact that you look at the ZEWs, the IFOs, the surveys all point to more optimism in Europe and pessimism in the US. So I can see them issuing a lot, more debt, and then that kind of pushing bond yields
Just
higher.
help us understand this a little bit more. So you've got the spread. I'll use my hands. We'll make this work. All right. So we're like this right now. Is that Germany coming up to the US coming down to Germany, or is it both?
It's both.
And it's equal parts, equal measures?
So we have 10 yields going to around 375 by the end of the year,
Okay.
and bond yields going perhaps towards, 330.
So Germany's
by the
doing
end
most of the
year.
work here.
We're just showing just the treasuries versus bonds, but you're going to see all of Europe doing a lot more.
The periphery comes along for the ride.
I guess to some extent.
Do you think they can handle that?
We'll have to see.
That's the big question, isn't it? Whether the periphery can actually handle that adjustment in borrowing costs that we're about to see off the back of the additional supply from Germany.
I'm guessing that this is going to create a lot of friction, I can imagine, among the EU. If you think about the fact that the periphery has been doing the heavy lifting with growth, and now they're going to get penalized by the fact that now Germany decides to borrow after they've been doing it, and then penalized for borrowing. So it creates a real interesting question mark here. I don't know the answer to this, because they can't engage in that kind of fiscal behavior as well.
Forgive me for the rapid fire, because it's a phenomenal call. What's the timeline for that call? to get back to that 45?
By the end of the year.
Wow.
I mean, a lot of the
Amazing.
repricing is going to happen, especially in bonds, probably towards the end of the year.
That's one to watch, that's for sure. Subadra, phenomenal call. It's good to see you, as always. Thanks for catching up with us. Subadra Rajappa there of SocGen. Looking at the bond market. We're looking to the equity market at the moment. It's just about unchanged on the S&P 500. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. President Trump signing an executive order requiring proof of citizenship for US voter registration in federal elections. The order saying current rules are not adequately enforced. The mandate is likely to face legal hurdles. Elsewhere, 5 Trump cabinet officials, members facing a lawsuit for allegedly violating federal laws meant to safeguard government records. The complaint flagging the group's use of Signal, which auto-deletes messages. The company, the group, used the encrypted platform to discuss military strikes in Yemen. And finally, the New York Giants have their next quarterback. 36-year-old Russell Wilson agreeing to a one-year deal with the team worth up to $21 million with over $10 million guaranteed. It's not bad. It's the 10-time Pro Bowler's 4th team in 5 years after a brief stint in Pittsburgh. You'd take that, wouldn't you? 1 year?
Yeah,
10 guaranteed.
Is that considered tips? Yeah, that $10 million tips. Honestly, look.
Depends how you write the law.
Okay, all I can say is that the amount of stress that their bodies undergo.
Oh, they deserve it.
They deserve
it. Of course they do. All right. Up next on the programme, we'll set you up for the day ahead and we'll catch up with David Rubenstein of Carlyle down in Washington. From New York, this is Bloomberg. The opening bout is about 40 minutes away. Equities are pretty stable here, just about positive by 0.1% on the S&P 500. That opening bout is just around the corner. Your day ahead, your week ahead looks like this. At 10 a.m. Eastern Time, remarks from Minneapolis Fed President Neil Kashkari. At 1 p.m., a White House press briefing. On Thursday, GDP plus another round of jobless claims. And on Friday, core PCE and another read on consumer sentiment in America. The UMich Consumer Sentiment Survey dropping just before the weekend. To discuss confidence and the US economy, one of the best guests we can do that with joins us right now, David Rubenstein of the Carlyle Group. David, welcome to the programme, sir. I cannot think of many people more dialed in to corporate America than you, sir. Can you tell us where corporate confidence is at the moment relative to where it was only a few short months ago?
I'm sorry. The question is where we are in terms of the economy?
Corporate confidence, David. Corporate confidence coming into 2025, sky high. You're very dialed into the C-suite.
Yes.
Has it fallen off over the last few months? And why do you think that is?
I think the business community generally is standing behind President Trump in many respects. They don't want to criticize him any way publicly, at least most of the business people and the CEOs. I think privately they will say they are a little nervous about the tariffs and what the impact is going to be. They're a little nervous about the inflationary impact of tariffs. And I think they do have some concern about whether or not we might go into a slower growth period of time. Projections for growth are below 2% this year. We were 2%, 2.5% last year. So I think there is some low-level concern, but people don't want to voice it publicly. I think they just want to be supportive of the president to the extent possible. So I think that's what the business leaders more or less feel, in my judgment.
David, do you see a pathway for all of the deals that were supposed to be getting done this year to come roaring back in the near future? Or do you think that those are really iced for the foreseeable future?
I think that the economy should do reasonably well this year, not as well maybe as it did last year. I think the uncertainties that the business community is living with are, one, what's the tax bill going to be? Two, whether the tariffs are going to go into effect or not, and how deep will they be or how significant they will be. And three, the geopolitical kinds of issues are, will Russia-Ukraine get resolved? Will there be more war in the Middle East? And will there be problems with China and Taiwan? I think the president, is dealing with all those issues, and I suspect he will spend a fair amount of time visiting some of these places at this point. Not too long from now, I suspect he will go to the Middle East in not too long from now, and I think probably he'll go to China, at some point this year as well. And right now, I think the biggest economic problem we have is uncertainty. What is the tax bill going to be? And is there going to be a slowdown in growth because the tariffs are scaring some people into not investing?
When it comes to scaring some people, I imagine the president has taken the temperature of Wall Street, of corporate America when it comes to those tariffs. The last week, we've heard him use words like he's willing to be flexible. He's willing to be lenient. Do you get a sense that this administration is prepared to maybe have some exemptions, be more lenient when it comes to April 2nd next week when they're coming out with their tariff plans?
I think the administration is not as ideological as maybe sometimes people think, and therefore I think they will announce what the tariffs are, but whether they'll implement them is another question. And I think the administration has used tariffs effectively so far as a negotiating tool to say, we will do this if you don't do that, and they get some of what they want as a result of it. So I'd be surprised if every tariff that the president is going to implement is going to go into effect right away in early April. I suspect some of these things will be used for negotiating purposes. And, you know, in the end, tariffs have two problems that people recognize. One, it tends to be somewhat inflationary, and two, it tends to slow down economic growth. Now, sometimes they can be useful. In a mature economy, you usually don't see tariffs being raised very high by mature economies like the United States, but sometimes they can have some beneficial effects. Remember, we've been living with tariffs that were imposed by President Trump in his first term, and we didn't really change them very much under President Biden. So we've been living with some tariffs for quite some time. Whether additional tariffs will really hurt the economy is just too early to know, because we don't know what the size of the tariffs are and whether they'll actually be implemented.
True. It's a point well made. David, it's great to catch up with you, as always, sir, to get your view on what's happening right now. And also, next time we need to talk baseball. Opening day just around the corner. David Rubenstein there of Carlisle. Thank you, sir. Don't miss David's conversation with Ellison Medical Institute founding CEO, Dr. David Argus, tonight on Peer-to-Peer Conversations right here on Bloomberg. Coming up tomorrow on Bloomberg Surveillance, Monica DeCenso of JP Morgan, Stuart Kaiser of Citi, Jim Karen of Morgan Stanley, Amanda Liner of BlackRock, and just getting confirmation, Venu Krishna joining us as well of Barclays after that downgrade to the S&P 500.
So he can tell us what we have to look at. Does soft data actually matter? Do our feelings, some people's, matter?
That cut to the price target. Your feelings matter. Yours do too. Mine, I hope. Yeah. Our feelings matter, Bramo. Is that what you wanted? From New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Iga Swiatek is looking for a second title in Florida after completing the Sunshine Double back in 2022, but the Polish superstar has yet to lift a trophy so far this season. The former world number one will face wildcard Alexandra Yelena in the quarterfinals in what will be their first meeting on the WTA Tour.